It was, yeah. Yeah, so you had the second for the wow.
Good morning, everybody. I guess we'll call this lively group into order. Welcome to the IFM group. I'm Linda Tizar, co-organizer or co-director or something with Mark Aguiar. And we're grateful to our organizers, Vincenzo and Pablo, for putting together what looks to be a great program. Just a couple of announcements. One is that everyone should have ticked off the code of conduct. It's a good thing to have. Please read it. It's a safety precaution for all of us, and it helps guide our behavior. On that note, too, we have some ground rules for how we run our sessions. You can ask questions during the talk that are clarifying questions, but please save your more thorough questions for the end of the session. I also say we have what has come to be called the Tizar rule. I don't know if that's a good thing or a bad thing, but the Tizar rule is that we ask that you, we want to make constructive comments on papers that are already quite excellent. So we want to focus our attention on their paper. You have probably, many people in this room have written excellent papers on all the topics we're likely to cover. So please don't give us a monologue about your own paper. You can, of course, send your paper to the authors afterward. But if I find that you are citing your own work instead of talking about their work, we might take the microphone away. So anyway, please focus on the papers. And with that, I think we'll start. Mark, did you want to add anything? No. Okay, so we do have Zoom going on in the background. This is great so that people at home can hear, but we aren't going to restrict our comments afterwards too much by being too obsessed about the microphone. The advantage of being in the room is that we can have give and take, and I don't want us to slow down too much by trying to pass a mic. But to the extent you can speak in the mic so everyone can hear, please do so. I think that covers everything, and let's start by going around the room, and please tell us your name and where you're from.
Mark Aguiar, Princeton.
Would you go for a Stanford?
Mario Percini, Purdue University. Rohan K. Berkeley.
Moritz Leno, Princeton.
Felipe Sanchez, MBER. Bruno Pellegrino, Columbia. IES.
Oxford.
Pablo Tonello, Brown.
Jens Rodriguez, USC.
I'm Roger Trivianti, Medical Belt.
Francesco Zanetti, Oxford. All already from the States.
Nick Dever, ABC.
And the lady said.
Ian Gavin, University of Louvain.
Rich Clare, Columbia.
We stay with the battle. I'm going to leave or something.
They are best music for it.
Otherwise,
How do you think, Arizona State? Right, how do you get for your national title?
Il est répondu, il y a un
Okay, with that, I'll hand it over to our organizers.
And go. Oh. Okay, first of all, thank you for having us and to get this paper in this program. We're very excited. This paper is joined with Sergio, Kurt, that is there, and he's taking all your questions, and then with Gabriel. So we're living in a world in which we have a lot of geopolitical tension. I mean, we've been living in a lot of war, the like trade problem, even football has not been completely immune, but this geopolitical tension, right? And what is the central question of this paper is that what would happen if this tension would materialize, and then a big country would exit a block of country, and who are going to be who will gain and who would lose, and we want to address this question both across country and within each country. So what we do in this paper will build a neoclassical and country general equilibrium model of the world economy. And what we do within each country, we calibrate as well as we can the distribution of the income and the distribution of the wealth. So think about in each country, they have all these households, and we match very well these two variables, these two statistics. And across country, we match country size, net foreign asset position, capital intensity, and markup. Mainly we focus about the markup in the US. And we use this model to study global fragmentation. So we're going to address the question, what if US stop borrowing from the rest of the world? And we also start to address the question that we're not going to see during this talk, what if China would do the rest, would do the same, right? So the first thing in order to address this question is to have a good model about the net foreign asset position. And one of the results of this paper is that if you take the income process seriously, so if you write an Ayagari economy and you put the right income process, you're not so far to match the net foreign asset position that we observe in the real world. So here what we put is like in the horizontal axis is the data of net foreign assets divided GDP. And this is in the vertical axis, what we put is what the model spill out when we target this as the model net foreign asset position with respect to the GDP. In the first panel, we only target the variance of the income process. In the last panel, we target up to the kurtosis of the income process. And what you can see, we would expect something that is around 1, the slope, right? That would be perfect. The slope is around 1.01, 1.3, and the R-square is pretty high, 0.35 and 0.40. So this is to say that if you take seriously the Ayagari model, the net foreign asset position is not actually a puzzle, it's something that the model can explain. Now, in some sense, this validates our model. And so we use the model to understand, okay, what is going to happen if now this big country will exit? And the first result is that heterogeneity is quite important because with the heterogeneity, together with the market incompleteness, we're able to study what is the elasticity of the net foreign asset position to the shock. So different countries are going to have different elasticity. And in some sense, having a country that is very elastic, we also shape the response of the less elastic country. This will shape the response of the interest rate of the world. And we're able also to say what is the net foreign asset position, because in this model, the net foreign asset position so the distribution is an endogenous variable, is an endogenous state. So if we focus on the US, what would happen if the US is going to close its external position? First, let's focus on the steady state. If the US is going to exit, this is going to be a big debtor that is going to exit the bloc. And so the rest of the bloc, the rest of the country, they need to borrow more, right? They need to increase their debt. And for this reason, the interest rate should fall. Now, this in the Ayagari economy are going to have two effects. The first effect is that the interest rate is lower, right? And then they also want to move the resources, and now they have like less return on the wealth, right? And this is going to decrease the welfare of the household. In some sense, this is what Ayagari and McGrattan document in their paper, where they speak about a big debtor a government that has a lot of debt. And if the government decreases their debt, this could be welfare decrease. On the other side, within the model, we have also capital. Now, if you believe that risk-free asset and capital close substitute, right? Then if there is a decrease in the real interest rate, there would be also a decrease in the marginal product of capital. So for the firm, it's going to be cheaper to rent capital. So the firm are going to expand their capital, but they're also going to demand more labor. And since they're going to demand more labor, the wage of the workers is going to increase, and this is going to redistribute resources from the capitalists to the worker. And this can be welfare increasing. And this is something that in close economic context has been documented by Davila, Hong, Kusel, and Rios rule. So in some senses, the shock welfare increasing or decreasing, it depends on which the two effects will prevail. Now, what happened is that this is like a city state to city state comparison. If we look at the transition, then the interest rate, right, will depend on how much the US will decide, how fast the US will decide to close itself. If it's going to close very fast, this is going to have a big effect on price. So there's going to be an overshooting on price. So it will amplify the effect in the city state. If instead the US is going to default on its net foreign asset, this is going to have a negative effect on the welfare of all the countries that are outside the bloc. Okay. So what we're going to present is first the model. The model is going to be very simple. So it's a neoclassical model, something that we can present in 3 slides. Actually, we can present in 1 slide, but then we are going to see the math. So think about country Yagari model. So country differ for patient, so different countries have different degree of patient, income risk, capital intensity, size, and TFP. Within each country, there are household. Oh, can you hear? So household decide how much to consume and to save. Household that are ex-ante identical, but they're not actually ex-ante identical. But household they can work, they supply work inelastically, and they earn a stochastic labor income. So think about me and Kurt. We wake up and we have a different labor income. I mean, different return on our labor income. And here's like where we match income inequality. So here we put a lot of effort in order to match the income inequality of the household. Then household can save using a risk-free asset, and they're subject to a borrowing constraint. For this reason, what we have is market incompleteness, right? You have only one asset and you have a borrowing constraint. And household are also ex-ante heterogeneous in their discount factor. And this we use in order to match the wealth distribution within country. So we assume that me and Felipe, for example, we have different discount factor. And this in order to match the wealth inequality. Now, on the other side, we have also firms. Firms is like they're very much more standard. So firms, we assume that there is a final good producer. So imagine that you want to produce this final good, and there are intermediate good producer. The only reason why we put the final good producer is that we want to have markup, right? So we need something to introduce markup. But you can think that intermediate good producers are all identical, right? So in some sense, we can study only this firm that is like hiring capital and hiring labor, so renting capital and hiring labor, and then they produce a final good. And the reason why we want to have markup is to speak about the fact that we know that in the US, the equity market was booming, and then in some sense, this can be correlated with the higher markup in the US. And then finally, we have market clearing. Homogeneous goods are traded across the world, and then aggregate saving within each country is equal to what? Aggregate capital stock, net foreign asset position, and aggregate profit within each country. So to be more specific on the household size, so here what in the slide, when you see something in red, is country specific, can be different across countries. So we dive it. So each household, we index household by I and country by J, and time is T. So within each country, each household can have, so we have two assumptions. Across country, there is a different beta to match the net foreign asset position. So I'm Italian, Matt is US, we have 2 different aggregate discount factor. Then within each country, if I'm Italian and Brogin is Italian, we are going to also have different discount factor to match the wealth distribution. And this means, and in this case, it's ex-ante heterogeneous, so there is not a shock. We're just me and Brogin, we're very different. And then it said that on the budget constraint is pretty standard. So each household gets some wealth from the past, and you receive the interest rate that is the world interest rate. This should be equalized across all the country. And then the household work, and you receive a wage that is country specific, right? Different country can have different wage. And labor is not mobile across country. And then there is the shock. This is the idiosyncratic shock, is where we put a lot of effort to match very well this income process. And then with this income, what they also decide to do can either consume or save in wealth. Now, wealth is quite complicated because it contains three things. It contains capital, it contains bond holding, and it contains firm share. Just to be clear, firm share is only the US firm share. We just focus on the US in that case. Okay, final good producer. Here, what we have is that we are allowed to have different elasticity of substitution across for different countries. And mainly you need to focus that the rest of the block, epsilon j is equal to infinite, so good or perfect substitute, and markup is equal to 0. In the US, we're allowed to have like some elasticity of substitution that is different from infinite. So you want to produce the final good, and then, intermediate producer is indexed by S, so you get all this variety together, and you produce the final good. The firms, the intermediate good producer, they employ labor, and employ capital, and they have a TFP that we are allowed to be different. Now, what is also different across countries is alpha J, because we want to match the capital to output ratio within each country. And then we focus on the symmetric equilibrium, which what we say is that the aggregate output is equal to what? Aggregate capital within each country, aggregate labor that is equal to 1. So this is an elastic labor supply, does not matter. I mean, matter for the wage, but not. And then there is a TFP that is country specific. Finally, we focus also, we want to just show what is an important equation, that is the marginal product of capital should be equal to the interest rate of the net foreign asset position of bond. That's an important assumption because whenever the interest rate is moving, then also the marginal product of capital is moving. Then there is profit that are firm specific, and then capital today is equal to 1 minus delta, the depreciation rate of capital tomorrow plus the investment. Depreciation we assume is the same across different countries. Okay, finally, final condition is that what we assume is that also country can be different. US is a big country, Italy is maybe a small country, so we're allowed to have different weight. You may think that so far we see the per capita income, per capita consumption, and we're allowed to have different size. So the sum of total consumption should be equal to what in this world? The sum of total output, net sum of investment, and then there is a trade balance. So this is overall, this block of countries, a block of country that is shipping resources to the rest of the world because overall they're borrowing with respect to the rest of the world. On the other side, there is asset market clearing, that is total wealth is equal to total capital plus total profit and net foreign asset position of the rest of the world. In this context, the rest of the world is mainly China and all exporters, if you look at the data. Okay. So we put a lot of effort, as you may imagine, because this is quite computational big model, in order to calibrate the model. We just see a small thing, but so here what is country specific? So discount factor, we match the net foreign asset position, and also within each country, we match the wealth distribution. Capital intensity is country specific, and we match the capital to output ratio. Markup, we only focus on the US, and this mainly for the fact that Atkinson, Heathcote and Perry, they documented after 2008, there was this boom in the equity market, and the increase in the net foreign asset position of the US is due to this increase in the equity market. And then country size, we use the GDP distribution. So with respect to the income process, we put a lot of effort also there, this is 1 year or 2 years of work, in which what we do, we try to match as well as we can the income distribution. So it's not only a normal process, it's a process that has kurtosis and the skewness. And it is so also they have frequent, and so they have transitory shock, but they also have permanent shock, and this permanent shock can be non-normal. And how do we do that? Okay, this was possible thanks to a very nice project that is Global Repository of Income Dynamics made by Violante, Guven, and other people, I think mostly in Minnesota. And so what they did, they put a lot of effort to find income process moment that could be comparable across country. And so we use their data to calibrate, to match the variance skewness of kurtosis, so 1 year and 5 year log difference. There is a lot of things in the paper about that. Okay, this is an example of what we do, just for the US. So in that table, you can see the variance skewness and kurtosis of the first 1 year log difference in the US, 5 years. These are the data. The second step is the estimated process. So we need to estimate the process. The third step is that we need to discretize the process. And also you can see how good we are. These are the parameters. And then in the US, alpha is equal to 0.24. And then these are different parameters for the US. No, not super important. Okay, one thing that is very important, why we have to do all this mess? Why we have to make this? Why can't we do something simple, right? So what we want to show you is that actually, if we take the income process seriously, we are not so far from the net foreign asset position. So what we do as an exercise, we set beta identical for country. So the only thing that beta does is that the sum of the net foreign asset position should be identical to the true one. So in this case, we're not targeting, we're not matching the net foreign asset position. And then we run a model in which a steady state model, which we have we only match the variance of the income process, and then we match variance of skewness of kurtosis. And I mean, we got the best figure, but in some sense, these are the data, net foreign asset position or GDP. This is what the model implies. And as you can see, as I showed before, is that we expect a slope around 1, right? And R square, I mean, what we get is a slope around 1 and R square that is 0.35, 0.40. So within this framework, if you take the income process seriously, having like the net foreign asset position, matching the net foreign asset position is not, I mean, it's not really clear. Okay, now we can talk about the shock. What is going to happen if the US is going to decouple? So the idea here is that the shock, let's think about city state to city state, right? So we are in a city state and then we compare with a city state in which US has zero debt. How we are going to move to the city state, you can think two things, two ways. First way is that President Trump or whoever is going to be the president is going to subsidize saving and tax borrowing, right, in the US. So the interest rate that US citizens will perceive is different from the world one. Or an alternative one is that the US are going to default and then net foreign asset position and close themselves with respect to them. We're going to see that in the transition, these two strategies are going to have different effects. In the city state, is going to be exactly the same. So what is going to happen in the US? Well, in the US, the interest rate, implied interest rate is going to increase. If you think that capital and net foreign asset position are substitute, the marginal product of capital is going to increase. This means for the firms it's much more expensive to hire capital, so they're going to demand less capital, they're going to demand less worker, production is going to decrease, and wage is going to decrease. Mainly we focus on the rest of the world. What happened in the rest of the world? The interest rate is going to drop. Why? Because a big debtor is going to exit. So the rest of the world need to borrow more. How they're going to borrow more? The interest rate will drop. Now, if capital gain is substitute with respect to the net foreign asset position, the marginal product of capital is going to decrease, which means capital is going to increase. So for firm now it's cheaper to hire capital. They want to rent capital. So this means that firms are going to increase their output, right? And they're going to demand more labor. How they're going to, since labor is inelastic, this is going to increase the wage of the workers. Okay? So let's look at how the shock are going to shape the economy. Here we have all the country in the data set. The blue line is the baseline, and the orange line is what our model implies. So countries are going to react in a different way. And this reaction will depend in terms of beta, income process, and many parameters that are within each model. So countries like Spain seem to react a lot to the shock, and countries like Italy seem not to react much. So what is going to happen in terms of consumption equivalent? So here what we brought is the aggregate consumption equivalent. So consumption equivalent seem to increase for most of the country except for Norway and for the US. So what is the main channel? We're going to see in the next slide. The main channel comes from the cheaper capital. So now capital is cheap. Firms are going to hire more worker, right? I mean, firms are going to get more capital. Since they want more capital, they want to produce more, they're going to also demand higher, more labor. More labor means more wage, and this will redistribute the resources from the capitalist to the worker. Worker usually are the one closer to the borrowing constraint, and this is going to be welfare increasing. And we show so in the paper, we don't have time today, but that capital intensity alpha J is quite important in the consumption equivalent. So for example, Spain soon seems to have this very strong effect on the consumption equivalent, mainly because it has a very high alpha J, because capital to output ratio implied by the data is pretty high for Spain. Why capital intensity is important? Well, because if you are using a lot of capital, this effect is going to be amplified. You think about use zero capital, alpha is equal to 0, so real interest rate will not matter for your production. To understand a bit better the consumption equivalent, we do a decomposition in the paper. So The decomposition is the following. So in this model, in the steady state, there are two prices that are going to change. One is the wage, one is the interest rate. So the first thing that we do is like, okay, let's focus on an award in which the wages is moving, but the interest rate is fixed. So, and this is like what you observe with the blue line. Blue line is that we compute the award or the steady state with higher wage, but the same interest rate. And you can see that this is welfare increasing for sure. I mean, households are going to have a higher wage. This is going to increase the welfare. Then we have a second channel that is now you're a household. Sorry. Oh. This is the orange line. Imagine you have like some saving and the interest rate on your saving is decreasing. This is a bad shock for you, right? And especially it's a bad shock in a Yagari framework because households want to move resources to the future. If the interest rate is lower, they can move less resources to the future. So the orange line shows the second effect, that is a direct effect. You have some wealth and the return on your wealth is decreasing. And you can see that this can be a pretty negative effect. If you like shut down the wage channel, this is not a positive shock. This is a negative shock. And then there is the third part that is this green part, that is the saving response. Endogenously, the model will react, the saving will respond, and this is an effect on the consumption equivalent. And then the diamond is the total, so it's the sum of the three. So overall, the model, what he predicts? He predicts the following. In case in which the shock will move also the capital, so firms are going to produce more, the shock is going to be, so the US living is going to be welfare increasing. But in case in which this will not move, the shock is going to be welfare decreasing. So it depends how much you like believe that marginal product of capital and risk-free asset are substitute or not. The shock can have very different consequences. Now, but the US is not going to jump to the new city state, right? We are going to move to a new city state. So the dynamic matters, so because the economy, so will not jump to the new city state. So what we do in the paper, we consider 4 different patterns. One is an immediate. Today, President Trump will announce that he will like exit, and then in 1 year, the US will move their debt to be 0. Second is going to be front-loaded. Most of the shock will occur in the first period, linear or back-loaded. So why this matters? Oh, I'm like, okay. It matters because the way which the US will introduce the shock will shape the pattern of the world interest rate. So the rest of the world, they care up to a certain point of the net foreign asset position of the US, but they will experience an interest rate that will move differently. So if this is like one period shock, so in some sense it's a jump, we call the jump shock. What is going to happen is that the US will announce today that it will close its net foreign asset position, and then the interest rate is going to drop quite a lot, right? So the rest of the world need to borrow much more. How can convince them to borrow much more? Well, the interest rate of this block should decrease and overshoot the steady state interest rate. If instead is front-loaded, it's going to be more smooth. If it's like linear, even more smooth. If it's back-loaded, it's a bit different because you think that in the future you are going to consume a lot. So this block know that in the future they're going to consume a lot. And today they want to they want to bring consumption today, but they can't because the interest rate is increasing. Now, in this transition, there is also something that you can see in the net foreign asset position a bit. There is also a valuation effect. We assume that the European and the country in the bloc, they were holding profit from the US. And since the US, is closing and the output is decreasing, they're going to suffer a shock. So in some sense, there is something negative extra from the steady state. Now, what is going to happen in terms of consumption equivalent? I think, we don't have time to describe much, but consumption equivalent is going to be, in some sense, less easy to describe in one slide. But the idea is that if you have a jump, if the shock was it was positive in the steady state, it's going to be much more positive. So you need to think that the shock is going to be amplified in the jump, and then the smoother is going to be the shock, the less is going to be the effect. And for example, I think for Norway, you cannot see much, but for Norway, the shock was negative. Since the interest rate is moving more, the shock is even more negative, right? So in some sense, transition will matters because it can amplify the effect. Now, what could happen if instead the US is going to default? So yeah, what is the exercise is that today the US will say, okay, I'm going to default on my next net foreign asset position. So what we assume is that within the bloc, all the country hold a proportion of the US debt that is exactly the same, right? It's not that one country is holding more than the other. So yeah, like what happened is that this country will wake up, they have some wealth, and the wealth, boom, vanish, disappear, right? So you can see here that yes, in that case, there is the fact that yes, the wage will increase, they're going to accumulate more capital, but the loss on the wealth is going to be much bigger. So what we plot here is the blue line, the US is going to default with respect to the case in which US exit jump. I finished that. So in some sense, because we think that the default and the jump, they're two most comparable things. So in case in the US with default, this is going to be a big effect. Now let me tell you something. So there is a lot. So what also we are considering, and we want to bring here to the NBER, but I mean, we're going to see, what if the capital adjustment is sluggish? So what is the reason? We saw that the positive effect is wage moving, right? And the negative effect is the interest rate to move today, right? Now, if capital cannot adjust immediately, you can think that the negative effect will prevail. Now, unfortunately, we try our best, but the code is still running. So we try, like, really. We didn't sleep for many nights, but it's like still running. So we don't have the result, but we think in this case, adjustment cost is going to bring the consumption equivalent to negative. So I decided to put the literature review at the end because I didn't know if I arrived, but just let me tell you that this paper is based on a huge and vast literature. So there is a literature in closed economy. Maybe some of the paper are not here, as you were saying, but there is a vast literature in closed economy about heterogeneous household, a vast literature of Hank method that try to solve this, and without this literature wouldn't be possible, and a last literature on global imbalance and capital flow. So these are like based on all this part, and there is even more paper that we need to cite. But without all this paper, we will not be able to run the code and to do any of this kind of thing. Okay, so I think I'm in time. I'm so happy. So what we want to show is that, first of all, income risk matters in determining the net foreign asset position. I know that many of us will like to write this model that are very nice and elegant, and we love the elegant and nice model. But if you want to understand the net foreign asset position, it seems that if you don't take into consideration this part of income risk, you're a bit far. Because income risk, I mean, how they also perceive that and how much they save and they borrow is quite, I mean, how much is the income risk is quite important to in determining the net foreign asset position. Now, who gain or lose if a big country exits the bloc? Here you have to put two if. First of all, what is the financial position of this country? If the big country is going to be a borrower or a saver, the facts are going to be different because the interest rate is going to move in opposite direction. And the second thing, it depends how much you think capital is substitutable with respect to the net foreign asset position risk-free asset. If they're close substitute, well, US leaving, positive shock, China's leaving, negative shock. If instead they're not close substitute, it's going to be exactly the same. Now, finally, let me finish with a word of wisdom. So we really hope that this will remain a thought experiment and that not we or any of our children will experience ever this shock. Thank you very much.
All right, perfect. So thanks so much for having me discuss this paper. I really enjoyed it. So what does this paper do? It has a world economy with 12 heterogeneous agent economies. They calibrate each country in a pretty sophisticated way. It's almost a paper in itself, the level of sophistication, both to match aggregates and with sort of rich heterogeneity in terms of income processes and discount factor heterogeneity to match both income change moments and wealth distribution moments. And then with that sort of very rich world economy, they consider decoupling scenarios. The main one that they talked about and that I'll talk about is US decoupling, where basically the US sets its net foreign asset position to zero. There's also a China decoupling scenario, which is that the rest of the world, the kind of non-12 countries, decouple. And then they look at steady state effects plus some transition. And then they look at the effects of this shock kind of both across countries and within countries, which I think is the really interesting part here. So why I really like this paper is that they have kind of one framework that turns out to be really well suited to handle two kind of important and closely connected distributional questions. So first of all, when you have decoupling like this, you can ask which countries bear the burden of adjustment, right? And Federica showed us some of those graphs. And then within each country, once you sort of figure out how big the global adjustment has to be, who benefits and who loses. And so you might think, okay, heterogeneous agent models are obviously built to handle number two, right? But the nice thing is that they also kind of give a well-defined, potentially well-behaved aggregate asset demand that helps pin down one, right? So, if you were in like a representative agent model, the real interest rate is fixed exogenously by primitives, basically, right? Unless you add additional frictions. So you can't think about sort of, say, the real interest rate changing to absorb shocks to asset demand. Here you can, and it's the same framework that gives you a basis to address distributional questions. So I think that's sort of a really nice, well-designed way to think about the problem. They also get kind of very sensible and I think some novel results. So for instance, they find that when one of these shocks causes R to rise, then average welfare usually falls. And that's true even if you're a creditor country, even if you have a positive NFA, when you might think it's good for you if world interest rates rise. Why is that? Well, because there's distributional effects. And I think also this is kind of a nice informative framework that'll be useful not just for decoupling, but also, you can put it in reverse and talk about integration, right? Or you can talk about anything in between, right? So I think it's a sort of a very flexible, very nice general framework. So what I'm going to do in this discussion is I'm going to focus mainly on the steady state and sort of the first order approximations and try to get some analytical traction to dissect some of these effects. And my main focus will be sort of the US decoupling exercise, both kind of the aggregate responses, what drives the interest rate change and what drives the NFAs, and then also what drives the welfare responses. And in the results I'm going to show you things that I kind of generated with my own code. So, I used to, when I got really excited about a paper, like spend 2 weeks, working and coding and trying to replicate everything. So last year, my wife and I had our third kid. So I have no time to do that anymore. But in the intervening time, agentic AI was invented. So I can do it anyway. And so it was a lot of fun. And I'd say, there are minor frictions, but I was able to replicate their key results very well. So that speaks, very well, I think, for Federica and Kurt and companies, coding practice, that everything all checks out totally independently. All right, so the US decoupling exercise. So what is this? It's where we take the US from negative 65% NFA to 0. And this, I'm going to talk about the long run. So we're just looking steady state to steady state. So this is a pretty big shift. Now, the effects might almost be puzzlingly a little tiny in terms of rates, right? So if we look, I don't know if this pointer works. Yeah. So the US has an interest rate increase that I calculated of about 2 basis points, a little more than that. The other countries decline around 5 basis points. Output declines a little bit in the US because you have less capital because rates rise. Output rises a little bit in the rest of the world. And then you have these kind of big offsetting NFA adjustments. So the lower rates, raise capital and output outside the US. And as the paper points out, those gains are strongly correlated with their calibrated capital output ratio. So this is kind of the aggregated effect. And then you can ask who absorbs the US liability. And so here I'm showing across those other 11 countries in the model, the change in the net foreign asset position. And you see there's like a lot of heterogeneity, right? That the paper emphasizes. You have like Sweden and Spain, heroically, massively drawing down their assets to offset the US, because the US is no longer a debtor. So somebody has to be the debtor, right? And so they're doing it. And other countries like Canada, Argentina, Mexico kind of doing very little, right? And so this raises 2 questions. So why, first, is the aggregate effect, kind of small in the long run on interest rates? Why does such a large balance sheet adjustment move R by only a few basis points? And then the other question is, why do we have these kind of big cross-country heterogeneities? So why do Sweden and Spain absorb so much more than Mexico or Argentina, right? And this, again, this framework, kind of is talking about both questions. I think it's very interesting for that. And so I'm going to turn to my favorite way of thinking about things, which is asset supply and demand. So this is something that my co-authors and I have emphasized in some recent papers, including Jackson Hole last year. Basically, the idea is you have some kind of long-run asset supply and asset demand curves. They both have slopes. There's things that shift them around. And you can think about equilibrium just in terms of, one of the curves moving, and then what are the slopes and how far does interest rates have to adjust. So concretely, in this case, we have what we call an asset demand semi-elasticity, ED, which is, basically how much do households respond in their long run wealth to interest rates. The asset supply semi-elasticity, which is how much do kind of the overall amount of assets available, which here for most countries is just capital, how much does that respond to a change in interest rates? And to first order, and the first order approximation works decently well here, you have two kind of nice identities. One is that for a country, the change in NFA over Y as you change R is going to be just, proportional to its pre-existing asset position times the sum of these two elasticities. Because these, as a change in R is causing kind of movements in different directions in terms of assets and demand and supply. And then if you have some required NFA shift, because this block suddenly has to take on a lot more debt or whatever the shock is telling you, then the change in R that you need is basically what is the shift, what's kind of the shift you need to achieve collectively, and then what's the kind of country wealth-weighted sum of overall elasticities that these countries have with respect to R, okay? And so, the change in R is going to be tiny if these elasticities in the denominator are really big, right? If people are really responsive to interest rates. And so, this technically, if you derive the first order things, there's a few other subtle interaction terms having to do with changing output and NFAs, but I verified they're like super tiny here. So this is pretty much it. And then we can ask, okay, well, how big are these semi-elasticities? What is the source of, say, this small R? And so the answer at an aggregate level, why does R move so little? It's that the semi-elasticities are really, really big, right? So I'm going to emphasize this demand semi-elasticity, which is like around 400 on average for both the US and the other 11 countries. The supply side is a lot smaller. So the asset demand curve is really, really elastic here. In some ways, it's not that far from a representative agent. So, these numbers might not make sense to you, the magnitudes kind of upfront. So basically what this means is that a single basis point rise in R is a 4.5% long run rise in assets. And so if you had like a percentage point rise in R, that would be like assets going up, once you take the exponent by like, I don't know, a factor of 5 or 10 or something like that, right? So this is incredibly responsive. You can compare, say, I've had varying numbers, so I'm not going to claim consistency on what ED is, but in our recent paper for the US, we said it was 7.6 instead of 445. And I actually had a very fun, lengthy conversation or debate with Paul Boudry a couple months ago, where I was saying it was like 7, or I was like, maybe it's like 20, and he was saying, no, it's 0 or negative. And so we had this like kind of long argument where he made a ton of great points about whether it was like 7 or 20, or whether he thought it was like 0 or negative. And these models are giving way bigger numbers, right? Now, so most adjustment is going to come from the household assets here, basically people just changing in the long run how many assets they hold, and that's equilibrating all the markets. Capital is kind of secondary. And then you can also give the same answer to why is there heterogeneity. It's just different semi-elasticity. So here I plot, and you can see the asset demand semi-elasticity country by country. And you see basically the countries that NFAs are responding the most, they're the ones who have the really elastic asset demand, right? Like Sweden is like, they responded the most in NFA. They have a semi-elasticity over 1,000, right? And the ones that respond the least are over here on the left. So why do you have these high semi-elasticities? Well, this is something about how these models work. So in sort of standard head agent models, asset demand approaches infinity, as we all know who's worked with this models, right? As beta times the gross interest rate approaches 1, right? So you have this asymptote where everything blows up in the long run. And, in the model, on top of that, they kind of fit the wealth distribution. And I think this was a very good way to fit the wealth distribution. And I do similar things. They discretize into 5 beta types. And so sometimes to fit the distribution, you need to space the betas widely. So the highest beta is going to be like super close to the asymptote, right? It's going to be way over here. And so then that type is going to hold almost all the assets, and it's going to have a really high elasticity because it's super close to this asymptote, right? And so the plot on right is sort of for the US. This is the highest type, which holds most of the assets and is pretty high sloped. But then it's going to get more extreme for like, Sweden and France and Spain, the most elastic ones, they're over here. So that's kind of what's going on. But I wouldn't just blame the beta heterogeneity. Stuff like this pretty much always happens when you have this kind of model and you try to calibrate it to high assets. It's sort of inevitable for this model. Okay, so with that, I'm going to quickly talk about welfare analysis, which is kind of the other big prong of the paper. So here I'm plotting the average welfare effect by country. Basically what they do in the paper, which I think is exactly right, is they take kind of consumption equivalent variation, what's the effect of these changing interest rates and wages. They calculate it at the individual level in a forward-looking way, then they average it over the distribution. So here I'm plotting that. You see what they said, which is that the US is hurt by decoupling and raising its interest rate. Everyone else benefits except Norway, which is kind of like the weird one, where Norway actually is hurt by this falling interest rate. The effects are kind of small, but that's just because the change in R in the long run is small. I actually think these effects are pretty big compared to the tiny R change. And so if we're able to get those semi-elasticities down, these effects would be even bigger, and I think they'd be quite even more impressive. I'll also note that this linear approximation that I plotted here is quite accurate. So what is that linear approximation? So let me define things. Average marginal utility, one weighted by assets, MA, and one weighted by labor income. So we kind of weight people in proportion to their assets and labor income and take their average marginal utilities. Then we can derive kind of a miraculous aggregate result for the average welfare change measured in consumption equivalent variation. This is much more non-trivial than it looks. It's a little specific to log preferences. It's like some miracle of cancellation, but here it is. And basically there's two terms. One is that if you have a positive external position, then you get a benefit. And then there's also this from a higher R. And then there's also domestic redistribution, which is proportional to the difference between the average marginal utility weighted by assets and average marginal utility weighted by labor. Okay. Basically, higher R means that there's less capital. That helps the capitalists, but it hurts the workers. So when you have a fall in R, like happens in most of the world, that hurts creditor countries through this NFA term, but it also helps them because the wage earners on average have higher marginal utility than the asset earners, so you get this kind of good redistribution right in the model. And so you actually have a very simple condition here at the bottom for when there's a gain from a fall in R. And that's true everywhere except Norway in all the kind of non-US countries. And why is that? Well, Norway is this like crazy petrostate, so they have high NFA, right? So they're really benefiting from a higher R. They want R to be higher, and they're relatively equal, so they don't have that big a difference in that ratio. So that explains what's going on with Norway. So this is a very cool result, by the way. I think that you can sort of see where international head agent stuff matters. Like this NFA term is overwhelmed by other stuff. And you can plot the external position versus domestic redistribution, and sort of see, okay, Norway is the only case where external overwhelms domestic. You can also look across the wealth distribution. They have these kind of cool plots where you see that, it's positive in CEV terms for everyone except kind of the initially richest. I have another decomposition of that, but I don't have time for that. Basically, you can see that for most countries, you have this kind of constant positive term from labor. Most people get most of their income over their lives from labor. So most of them have a benefit from a fall in R. But a few rich capitalists kind of, they really are hurt by a fall in R from their asset returns falling. These two terms sum up to the overall one. Okay, so out of time, but basically, paper has other interesting exercises. They have the China withdrawal, which is kind of a mirror image of the US exercise. They have transition exercises, which are interesting because they have a bigger R movement. They have an interest rate overshoot. So that offsets some of the problems I talked about of the long run where R isn't moving enough. So this amplifies the redistribution effects. On the other hand, it sort of forces us to take a stand on what decoupling means, right? And so that's where they're trying different exercises, like is it default? Is it kind of a change in taxes, which I think is quite interesting. Where to explore next? Obviously, we can discipline maybe those sky-high asset demand elasticities. We might be able to do that with life cycle structure. We can also ask, how important is productive capital and wealth, as the authors pointed out in the paper, because of this kind of central wage capital redistribution channel. Then there's more speculative directions I think are interesting too. So to sum up, I think this is a super exciting paper, a very broad agenda that it raises. The international business cycle shock, first you can ask, or international balance sheet shock, you can ask what countries absorb it. That changes interest rates and wages. You can get that from the model. And then you can ask which households gain or lose. They have a very natural laboratory for both of these questions across and within country incidents, potentially like a super, cool, seminal canonical paper and framework. So I'm very excited about it. So thanks, guys.
Thank you. So now we can open the floor for questions. Who would like to ask a question? Okay, let's go with four, and then we see if there is. Why don't you go first? Oh.
Super interesting paper. I had a question about the choice of the set of countries that you used in your analysis. It's fairly restricted to the countries that potentially you could include in the model. If I understood correctly, it's because you don't have grid data for the remaining countries, and so you cannot properly calibrate their income process. But my question to you, wouldn't it be better to include them anyway, and you do some imputation because there's a risk that you're not really capturing who, for example, absorbs the liabilities in place of the US. So how did you solve that trade-off? And then more of a clarifying question, if you could elaborate a little bit on the role of markups, which you have for the US as opposed to the rest of the country.
No, just talk loud.
Okay, so I really enjoyed the paper and the very good results, and also really like Matt's discussion a bit. So as I was listening to it, I asked myself, because this is not just any ordinary country putting a tax on capital flows or defaulting, right? So what is likely to happen if the US were to actually tax capital inflows? Even forgetting about default, just tax capital inflows. Your model would predict that this is an environment where the rest of the world, actually most of the rest of the world should be pretty pleased because they end up with lower interest rates, and that on net is good for them. Having been at the IMF at the time of the last year when all this talk was happening about taxes on capital flows, every country in the world thought that would be an absolute disaster. That if it turned out that there was a tax on capital flows, or there was any talk, obviously the talk of US defaulting would be hugely problematic. And the reason for that is basically, the US debt is considered to be the safe debt in the world, it's the safe asset. And if you have a change where the US is putting capital controls or the US is defaulting on its debt, it's a total risk-off environment at that time. Everybody's uncertain about debt of every country in the world. Your balance sheet is ruined because it's not just the house, it's not just the savings that you have, but it's also that affects your ability to invest and raise capital. I expect that will be a moment where you would have a collapse in investment across the world. Everybody would go to cash, right? So everybody would rush to cash because they had this tremendous amount of uncertainty. So I would just say that in terms of thinking about this going forward, especially in terms of whether this is the experiment, maybe there are mechanisms that you need to think about which are separate from the more kind of standard mechanisms you'd expect to see play out.
Yes, Roberto, and then what's the other one? Yeah, and then Jess.
Yes, thank you for the paper and discussion. Very interesting. But when I was actually listening to the paper, I was thinking whether we did not have a lot of the answers in previous literature. You mentioned, for example, the great papers by Quadrignini, Mendoza, and Rios Rule, and there were related papers by, say, Caballero, Fargi, Rinches, which did what you asked the same question, but in reverse, right? They said, what if we have this multi-country world or multi-block world that starts with autarky, and then we go into, to trade, right? And then you're doing exactly the opposite, right? You have a trading economy, and then you essentially are going to the autarky situation. And I think that if you think of the problem that way, then many of the conclusions of your paper essentially are in that literature already, like, for example, the impact on interest rates and so on. Now, what actually also strikes me is the magnitude of your paper is much more quantitative than these other papers. But I think that the discussion of welfare actually strikes me for a number of reasons. One is that apparently the numbers are quite big for some countries. So I was wondering, So maybe those countries should just like organize and say, stop lending to the United States.
So I was going to ask a version of Gita's question, so I'll be brief. I would love to understand a bit more about what happens as a result of aggregating China in the rest of the world, to get a sense of the model's ability to, if you think of global imbalances, it really seems like the US is a big negative NFA, China's a huge positive NFA, and I can't tell if how the structure of your model would rationalize China in a way that if it's not in the the kind of rest of the world bucket. And the other thing I just couldn't follow is in the exercise, are you beginning from a world where all of the NFAs already exist, but we have current accounts in balance, or is this a model that's also about kind of ending the current big pattern of current account imbalances today?
Let's give a bit thumbs up once.
Okay, I think I have them all. I'll go in order. So to Bruno's questions, you're right, like we took the countries from grid. We thought we were going to expand because grid said winter 2025, they were going to add like 15 more countries. So we waited and it's summer 2026 and they haven't added them. So we thought the data was going to come online. So that was why we waited, but we could add in other countries and kind of put in the best estimates that we have. I mean, presumably you'd want to kind of add in countries based on kind of their current gross NFAs, like, as they get smaller and smaller, then the effects probably wouldn't be as big. In terms of markups, kind of our view from, like Federica said, reading the Atkinson, Perry, Heathcote paper was that kind of US equity is special. And there's good US data to try to discipline that. We've tried to do some things across countries to also have equity, and we get results that look very funny. So I kind of agree that would be interesting to do, but kind of getting consistent cross-country data to try to measure it has kind of proven elusive so far. To get his question, I completely agree that there's no notion of kind of finance or risk in this model. I would say like maybe one interpretation is that, who loses from this decoupling in the rest of the world? It's kind of rich people. I don't want to say that people with high wealth kind of influence political decisions of other countries, but for sure, rich people in the rest of the world do not want this at all. They all lose. Kind of poor people are the ones that win in terms of wealth. So, people that care about their big portfolios and things that could be part of what's going on in the political economy. I don't want to lean too much onto that, but that kind of comes out naturally from our model. But I agree with you that I think for the long run, maybe that's not as much of a question because, I don't know, 50 years from now, presumably there would be another country that arises as kind of the safe asset and the safe debt. So I think for maybe long run comparisons is less important. For the short run dynamics, I agree, if US treasuries get defaulted on, there would be huge impacts in the financial system that we have completely unmodeled. And so I think, maybe then it's kind of safer to look at the long run comparisons than the short run dynamics to kind of exclude the finance component. But I think that's where we are. And, we're completely silent on uncertainty. And clearly in the short run, that would be very, very important. To Roberto's questions, I agree with you that kind of that was what Federica tried to say at the end, that we were connecting to a lot of literature. And I think kind of our answer was kind of was very succinctly put in Matt's slides. I'll just go back to it. If we can get to it here, that, what we have is we kind of have a theory of kind of how big the imbalances are and kind of like who absorbs them and kind of why. So I think this is kind of what we add to the existing literature. By having the heterogeneous agents, which kind of pin down the elasticities in the within country, like this is what's new and this is the quantification. And so I agree with you that the basic forces were kind of there in previous models, kind of now running in reverse. But, we kind of think that we discipline these margins well with the framework. So thanks, Matt, for helping me answer that question. Jesse's question. So right now, our view of China is like, China wants to save X, doesn't matter anything that happens. I think for a time, maybe that was a good representation of China. And part of our motivation for thinking about a China kind of closure is that it does look like China is kind of slowly unwinding its position of US treasuries, at least. So I think it would be very interesting to try to model kind of what's going on with China. But for right now, they're basically just, they're just a shifter in kind of world asset supply. And that's kind of all that we've taken. The NFA, Federica, do you know the answer to the NFA current account question, part of Jesse's?
So technically we are out of time, but consider that we started 5 minutes late. I will give a very one question. Mario,
Thank you, Vincenzo. Agree with a lot of the previous comments. I guess I had two questions. One is, right, you're the chair. One question, term structure of debt. So given, especially when you're doing the front end and backloaded transitions, the unexpected change in the profile of interest rates going forward would interact with the term structure of debt. So that might be an interesting channel to explore.
Thanks. I agree. Right now, everything is, kind of short-term, one-period assets, and so that channel is completely shut down. But that would kind of give another kick to revaluation effects to think about for putting in going forward.
okay, I apologize to Nick, but we are leaving.
Yeah.
But not everybody. No,
All right, thanks a lot to the organizers for including our paper. So this is joint work with Damien from the IMF. The title of this paper is Unbalanced Financial Globalization. So I want to start with a motivating picture. So what you're seeing on this chart is the external liabilities divided by GDP, the average across a bunch of countries starting in 1971. And what you can see from this chart is that this number starts at about 25% and it raises all the way up almost to 200% by 2019. So this is basically financial globalization in a nutshell. It's a massive explosion in cross-border investment positions. And what we basically want to try and answer in this paper is what were the real macroeconomic implications of these past 5 decades of financial globalization. What do we mean by real macroeconomic implications? We mean stuff like capital allocation efficiency. So is capital better allocated across countries as a consequence of this increase in integration? 2, the spatial distribution of economic activities. Where does production take place? Factor prices. So what happened to wages and the cost of capital in different countries? So in order to answer this question, what we do is we use a multi-country dynamic spatial G model of international production and investment. And this model is going to feature a demand system for international assets. It's going to build on my previous work. Now, within this model, within this dynamic spatial G model, what we're going to do is we're going to do a dynamic wedge accounting exercise. So by taking the model to the data, we're going to invert from the data these wedges that we call reveal financial openness. These are going to capture the degree to which a country is able to attract and retain investment, so both inward and outward openness for each country. And in doing so, we have to confront a data challenge. If you want to look all the way back to the 70s, you basically have very little data. First, you don't have data about de jure restrictions to capital flows, or at least you have very little. That's partly why we use a wedge accounting exercise. But also, you don't have data on bilateral investment positions. So you may know, for example, how much France is investing in the rest of the world or is receiving from the rest of the world, but you may not know how much France is investing in Brazil or South Africa. And so we're going to show that despite this challenge, within our model, we're still going to be able to identify for each country and each year an inward and an outward wedge with the little data that is available. Basically, all we're going to need is multilateral external assets and multilateral external liability position plus national accounts, basically the PEM world tables. Okay, so what do we find? First, we look at the cross-sectional as well as the time series variation of these wedges, and what we find is a striking degree of heterogeneity in both the pace as well as the direction of financial opening. And this is what we basically call unbalanced financial globalization. There's various dimensions of heterogeneity, but one that we focus on in particular is the high income versus low income split. In particular, high income countries became more inwardly open, so they're better able to attract capital, while low income countries became relatively more outwardly open, so capital escapes these countries much more easily. Then we can play with the model and try and understand the real implications. And so in a counterfactual sense, we compare this unbalanced globalization world that we see in the data to a no globalization world where we keep the wedges at the level of the 1970s. And what we find is some counterintuitive implication. We find that actually in a counterfactual sense, world GDP is lower. Capital allocation has become worse. Cross-country income inequality is higher. And in low-income countries, wages are lower and the cost of capital is higher. If you're familiar with the literature, this is basically the complete opposite of what you would expect from an international RBC model. And so your first thought may be to say, okay, Bruno and Damien just wrote a stupid model where financial integration is bad. That's not the case. We can do a little bit more playing with the model. And what we do in particular is we construct another counterfactual, which we call a balanced globalization scenario. The way you want to think about this, it's a world where all countries open up at the same pace and in the same direction. And what we find is that in this balanced globalization world, all the traditional prediction of an international RBC model go through. Capital allocation improves, inequality goes down, and in low-income countries, wages rise and the cost of capital goes down. And basically, the main takeaway is that it's not really that financial integration is bad per se, of course, but it's really these deep asymmetries that have manifested throughout the last decades of financial globalization that are really generating what otherwise might seem like counterintuitive result. And so the conclusion is basically we need, is really super important to model spatial heterogeneity. Now, of course, there's a huge literature that we contribute to: financial globalization, global capital allocation, asset demand, wage accounting, capital misallocation. A quick word on where we stand with respect to the data. Of course, there's been a lot of work, including by people in this room, trying to understand why the direction of capital flows is not what we expect in the data. Our work is pretty much orthogonal to all of these. We're not trying to take a stance really on what the underlying forces are. The wedge accounting actually tries to let the data speak in general. Instead, what we're really focusing on is the spatial heterogeneity. This is the really new stuff that we're bringing to the table, and we show you that the modeling the spatial heterogeneity is absolutely crucial. Okay, so let me dive straight into the model. So this is a multi-country model. We have uppercase I number of countries, and I'm going to use the following notation. I'm going to use the subscript I, lowercase, to denote the destination country. This is the country where capital is used. And I'm going to use the lowercase subscript J to denote the origin country. This is where the investors are located. Time is discrete and indexed by T. Now, each of these countries is going to have a representative firm that produces a homogeneous tradable good that can be either be consumed or reinvested as capital for production in the next period. Each of these representative firms uses a Cobb-Douglas constant returns to scale technology. YIT is going to be the GDP of country I at time T. There are three inputs: capital K, labor L, and X is natural resources. The corresponding Greeks represent the output-input elasticities that we let vary across countries and over time. Omega is going to be the expected productivity, and there's going to be zeta, which is a log normal productivity shock that introduces risk. Now, of these three inputs, two have to be used locally, labor and natural resources, while capital can be deployed across countries, and that's how we think about international investment. Now, what do these firms do? They maximize profits, which we denote by uppercase pi, and this is simply equal to the capital income share. Is the GDP less the compensation of labor, PL is the wage rate, minus the rental rate of natural resources, where PX, minus the share of natural resources, PX is the rental rate of natural resources. Both of these two input prices are determined in competitive input markets and are therefore equal to their marginal product, okay? So that's the usual. On top of that, very important object in our model is the marginal product of capital, MPK, which turns out to be, in this case, equal to also the profits per unit of capital invested in the destination country. Capital is durable, it depreciates at a rate with expectation delta, and that means that when you invest a unit of capital in some destination country, what you get as your gross expected rate of return is 1 plus expected marginal product to capital minus delta, okay? Now, let's talk about the agents that populate this economy, the household sector. Now, in each origin country, we're going to have dynasties of agents that are born and they live for a random amount of time. We are going to denote the cohort that is born at period B in country J with the subscript JB. And when a cohort is born, it's endowed with natural resources XJP and with an amount of labor LJP. And they're going to supply both of these inputs inelastically. Now, these agents have a life cycle. They are born as workers. So they're workers when T time is equal to B, their birth cohort. And so in the first period of their life, they earn income from labor and natural resources. From the second period onwards, they transition to being capitalists. So they keep on living off income that they saved in the form of capital from the previous periods. Okay? Now, regardless of whether they're workers or capitalists, they every period they make a consumption saving decisions. And so we denote by CJBT the consumption of port B in country J at time T, and the corresponding wealth is going to be AJBT. These agents have recursive log utility, so their lifetime utility is VJBT, and it's linear in the log of consumption. And these agents discount future utility with some time varying parameter that we call sigma JT. We also let it vary across countries. Now, this is the budget constraints for the cohort B in country J at time T. Consumption plus saved wealth must be equal to previous period income, which depends on whether they're workers, so a new cohort, or capitalist, a season cohort. If it's a new cohort, then their income is labor plus natural resources plus some transfers from the government, which include bequests from agents that have previously died. If they're capitalist, then their income is equal to the wealth that they saved in the previous period, so AGBT minus 1, times RJT. What's RJT? RJT is the gross rate of return earned by investors on between T minus 1 and T. So it's the rate of return on their portfolio. Now, why did we set up this life cycle model? Is because it gives us a lot of tractability. In particular, we get a separability between the saving and the asset allocation decision of all of these agents. And in particular, we're going to get that all of the agents in country J at time T, regardless of their cohort, they're going to save some portion sigma JT of their wealth. So that's the saving decision. Let's talk about asset allocation. We have an international asset demand system, so we're going to assume that investment is intermediated by a bunch of financiers, one for each origin countries, that are going to allocate the savings of the corresponding households using this logit asset demand system. We just assume this in the paper for expositional purpose, but we actually have micro foundations for this in the appendix. And this is the portfolio share equation. So WIJT, is the share of country J wealth that is invested in destination country I at time T. And this is the expression. It has a bunch of moving parts. So let me explain them one by one. So we have this calligraphic R is the risk-adjusted rate of return on capital for the corresponding destination country. It's equal to simply the expected gross rate of return on capital, which depends on the marginal product of capital, plus this term here, which is a risk adjustment. It depends on the volatility. VIT is the volatility of the TFP shocks in the destination country. So you want to invest more in countries where capital is more productive. And by investing, investors change the NPK in the destination country. But they also want to invest less in countries where TFP is more volatile. Then there's this term KIT. This is simply the capital stock of the destination country. It's a gravity effect. You want to invest more in larger countries. So this is a known empirical regularity in international investment. And then there's this term here, tau IJT. This is basically the star of the show. It's our revealed financial openness wedges. They capture de facto impediments from investing from country J to country I. Okay, and so this is actually, when we take them all to the data, this is what we get from the wedge accounting exercise. So these wedges, these taus are going to allow us to match the international investment positions of different countries. In addition, there's going to be an elasticity that regulates the the relationship between these portfolio shares and the risk-adjusted returns that we call beta. Okay, so here there should be like an image that for some reason it's not showing. But basically, let me tell you what's otherwise here. So we have a vector of capital stock here. So liabilities at every point in time should be equal to the matrix of portfolio share W times, and here there should be a vector of wealth AT. Okay, so at every point in time, AT, the vector of wealth times WT, the portfolio share, has to be equal to KT. This equation is important because it's going to matter for how we identify the wedges. Okay, so talking of the wedges, for our quantification, we're going to impose some additional restrictions. We're going to make the following assumption that the wedges have the following structure. So in particular, TIJT is equal to 1 if I is equal to J. Basically, we're going to assume that domestic investment is unrestricted. We're going to focus on international investment frictions. For international investment, that is I different from J, we assume that we can decompose this wedge, tau, into an out wedge that applies at the level of the origin country J, times an in wedge that applies at the level of the destination country I, okay? Why do we do this? Remember, one of the challenges that we face is that we don't have bilateral investment data going all the way back to the 70s, so we don't have variation in the data to identify purely bilateral wedges. By making this assumption, we're actually able to squeeze every bit of information available in the little data that we do have and recover an out and an in wedge for each country in each year. In more recent years, actually, we can also compute bilateral wedges, but this is only for the very last part of the sample. Okay, so let me tell you how we identify these wedges. So we have data on external assets and liabilities. We are going to denote with a tilde, basically the external position. So external assets and liabilities. So when we put tilde, it means external. We can do exactly the same thing for the portfolio share. So when we put a tilde on top of W, it means that we are excluding domestic investment from the denominator of the equation of the portfolio shares. Now, when you do that, something quite cool happens. The out wedge drops out of the equation, and you're left just with the in wedge in the equation for the portfolio share. Then you can rewrite the equation that I wanted to show you before, but didn't show up. And its K is equal to WA, except that now we are writing everything in terms of external position, and we observe everything in the system of equation, except for W, that depends on the in wedge, okay? So W is a function of the in wedge, but that means that we have a system of n equations in n unknowns. And so by solving the system of equation for the in wedge, that's how we identify the in wedges, okay? So that completes the first part of the identification for the in wedge. For the out wedge, then it's actually quite simple. All you need to do, you get from the data you have on capital, external asset, liability position, you recover domestic wealth, and then you can compute the domestic portfolio share. So WJJT is the domestic portfolio share for each country. Once you have that, bam, you have actually an equation that gives you in closed form solution the out wedge for each country. And then we are done, basically. That completes the identification procedure. We have our wedges, and what's the next step? Well, the next step will be to actually verify that these wedges make sense. Actually, before I do that, let me tell you what data we need. It's actually quite simple. We need the Pemberton table. So the Pemberton table, we get GDP, capital stock, employments, and the labor share. An additional piece of data that we need is the share of income for natural resources that we can get from the World Bank. And then the external assets and liability position we get from the database of Lane and Milesi Ferretti. When we merge all of this stuff, actually, we have a pretty large sample of countries. We have a panel of 58 countries that starts in 1971. There are some important countries missing, China and Russia, for example. If you're concerned about that, what we have done is we repeated the entire analysis with the largest panel of countries that starts in 1993, and that basically includes virtually all of the world GDP, okay? And our results are not sensitive to that. Okay, the next thing I want to do is I want to validate these wedges. I want to make sure that the way that these wedges vary, especially in the cross-section, makes some sense, it correlates in the way you would expect with de jure measures of financing friction. So we correlated to measures of capital account openness, tax treaties, capital controls, political risk. In general, they correlate strongly and in the direction that you would expect with all of these variables. Now, a lot of these variables only exist for more recent years, so a lot of this is cross-sectional variation. If you're wondering about the time series behavior of this wedge, we have also another validation. We basically do an event study. We get from this paper by Beckert and Harvey as a list of emerging market liberalization episodes. And what we do is basically we run a diff analysis. We verify that following around an emerging market liberalization events, these wedges react in exactly the way that you would expect. They reflect an increase in inward openness. Okay. So now that we validated our wedges, now we can go and study what happens with these wedges. So before doing that, I define an object that is going to be useful in the counterfactual. It's called the world revealed financial openness. It's basically a summary statistics of how open the world is as a whole. It's just all of these wedges averaged using gravity weights. And you're going to see why this is useful in a minute. I'm plotting this world reveal financial openness as this dark blue line on the left axis. Is basically, think of it like 1 minus the tax. So an increase in openness over time. The average tax on international financial flows decreased from about 28% to about 16%. So a very significant increase in openness, but we're still very far away from full liberalization. Okay, and now let me show you sort of like the key factual finding of the paper. And what you're seeing here is the various wedges averaged into 4 lines by high income, low income countries, and inward versus outward openness. So the 2 top lines in this graph are high income countries. They are dotted, okay? The 2 solid lines on the bottom, these are low income countries. They're solid. Light blue is outward openness. Dark blue is inward openness. So what do we see from this graph? We see that, first of all, high-income countries already start at a much higher level of integration back in the 70s. That's sort of expected. But then something interesting happens over time. High-income countries become even more open, but in particular, they become more inwardly open, so better able to attract capital. What about low-income countries? Interesting, when you look at their inward openness, almost nothing happens over time. They stay almost in a state of virtual financial autarky. Instead, what really increases for low-income countries is their outward openness, meaning capital escapes these countries much more easily, okay? So, and this is basically what we refer to as unbalanced financial globalization. Okay, next, we want to look at basically the implication of this unbalanced globalization. And so we construct a bunch of different counterfactuals. Our benchmark is always going to be a no globalization world. This is basically a counterfactual where we simply keep the wedges at the level of, at the level of 1970 for all countries and in all years. So basically, this is going to be the reference level of 100. Everything is relative to this no globalization. Then there's going to be a symmetric globalization scenario where, and this is where the World Openness Index comes useful, we're going to define it as a world where all countries increase their wedges, all countries and in each direction, they increase their wedges at the rate of the world openness that we observed in the baseline. So in this scenario, the world as a whole becomes more open at exactly the same pace as in the data, but we remove the increase in cross-country asymmetry over time. And finally, we have a more extreme counterfactual that we call the convergent scenario, where gradually over time, here all countries converge to the world financial openness index. So basically, we get rid over time of all of the pre-existing asymmetry. Okay, this is sort of like a very balanced globalization. So what do we find? So here in this table, you have a bunch of statistics. You have world GDP, the variance of GDP per capita, capital per employee in both high-income countries as well as low-income countries. Here you have 3 scenarios, only 3 because remember, everything is relative to no globalization. We have unbalanced, start because this is what we see in the data, symmetric and convergent. Now, all of these counterfactuals are by construction identical at the beginning of the sample in 1971. And then see what happens by the end of the sample, 2019. So in the unbalanced world, world GDP is actually lower compared to no globalization by about 5.8%. So a worsening of capital allocation. Variance of large GDP per capita is higher by about 3.4%, so more inequality. High-income countries actually get more capital, about 5% more capital stock per employee, while low-income countries get about 10% less capital stock per employee. Is this because financial integration is bad? No, because when we look at the symmetric and the convergent counterfactual, basically all of these results are completely flipped. So in the symmetric world, actually world GDP improves by 5.7%, and in the convergent scenario, world GDP improves by more than 23%. In these scenarios, cross-country inequality drops significantly. And again, the movement of capital is completely reversed in this balanced globalization scenario. Actually, in symmetric and convergent scenarios, high-income countries lose a lot of capital. Again, not in a time series sense, in a counterfactual sense. And low-income countries gain a lot of capital, about almost 50% in the symmetric scenario and over 170% in the convergent scenario. Okay, so again, everything is flipped when you consider a balanced globalization scenario. What about wages? In the unbalanced globalization world, because high-income countries get more capital, that pulls up the marginal product of labor, and that increases wages in high-income countries, and it pulls down wages in low-income countries. Again, all of these effects are completely reversed when you consider these balanced globalization scenarios. In the symmetric and convergent world, actually, high-income countries experience lower wages, and while low-income countries, actually, wages rise significantly, particularly in the convergent scenarios. The opposite, of course, happens for the rate of return on capital. Capital in the unbalanced world, the capital becomes more expensive in emerging markets, but it becomes less expensive. The low cost of capital goes down in these balanced globalization scenarios. I mean, you get the gist by now. We do a bunch of robustness checks. So as I say, first we repeat all of our analysis with this shorter and wider panel of 1995 countries. That doesn't change anything. Now, these multilateral investment positions include a bunch of different assets. So you might be concerned, for example, what about the role of government debt? So for example, one thing that we can do is we can remove from our analysis 45% of bond position. That's our estimate of how much government securities account for bonds. Nothing changes. If you're really concerned, we can also do it by completely removing bonds, and still our results are qualitatively unaffected. Finally, as I said, for the most recent part of our sample, we can actually identify bilateral wedges, and we can actually show you that they correlate extremely strongly with our combined inward times outward wedge, meaning that in some sense, there's not too much variation that we're losing in the data by making this assumption, this decomposition assumption on the wedges. Okay, so I'm pretty much out of time, I think, so let me conclude. So we presented this dynamic spatial model of international investment and production, and we did this wedge accounting exercise to compute revealed financial openness for a bunch of countries, inward and outward. We used these wedges to document this new factor we call unbalanced financial globalization, basically huge heterogeneity in the pace as well as the direction of financial opening. And what we found using our model, counterfactual analysis, is that it has this unbalanced globalization has counterintuitive implication for the spatial distribution of economic activities, factor prices, and cross-country inequality. And we found, using more counterfactual analysis, that it's really not financial integration is bad per se, but it's really the spatial heterogeneity that has a huge effect, and it can actually undo the effects of financial integration. And that goes to show just how important it is to incorporate spatial heterogeneities when you want to understand the implication of financial integration. That's all for me. I look forward to Felipe's discussion.
Okay. All right. Thank you so much, Pablo and Vincenzo, for having me discussing this super interesting paper that I have seen the evolution over the years. So let me try to frame the paper a little bit. So this is a big question, and a question that we're all very familiar with. So at the end, the way I understand this paper is about the locust puzzle. So basically, you have countries that are poor, that have very high MPK, they should be hungry for capital, and instead, the capital flows in the opposite direction. And our type of models, our RBC models, are telling us that what we should see is that the capital flows in the other direction, and that basically the countries become richer, and we're all happy and singing Kumbaya. But that's not basically what we see. I'm going to just use this. And then the allocation puzzle is basically that capital flows in the different direction. It actually goes to high NPK countries. And then the question a little bit that Bruno and Damian are asking is, has globalization make this worse or better? And you see there is a bunch of papers of people in the room. I'm going to try to credit them in the bottom when needed. Now, the way I see this literature now more narrowly has to do with how do we understand the flow of financial assets across the world. And as an observer, that in this time I'm going to be fine, Linda, because I have no papers on this, okay? I divide this literature into two camps. So there is one camp that is like, give me all the data that you can have. This is the Ellen Ray stuff of the elephant, you know? It's like, if you give me every single data, I can clear the market without any structure. The problem with that is that after that, you cannot do much counterfactual, and it's super heroic to think that you have all the data. On the opposite camp is Bruno. Bruno is, you know what, data is scarce. I'm going to put a bunch of structure. I'm going to be heroic on the type of structure that I'm going to put. And after I put enough structure, I'm going to need very little data, and then I will be able to do a bunch of things, those counterfactuals that he was showing us. Now, those counterfactuals, you need to believe them as much as you believe the heroic assumptions that Bruno is making. So you need to understand that these things go hand in hand, and this is the trade-off that you see. Are you going to try to get all the data and not make modeling assumptions, or are you going to try to save in terms of the data? Bruno is in the camp of these very structural demand impositions. Now, what's the goal of the paper? It's to try to measure this de facto financial openness. And you're going to see that, and you saw that in Bruno's presentation, he thinks of this as wedges. So although these are more than capital controls, the way we think about globalization, he's thinking these are taxes on flows, okay? They're going to be much more than that, and that's going to be part of my discussion. But if you want to interpret this as financial globalization, you have to think of them as restrictions of mobility. So what's going to be the method is going to be a dynamic spatial model with a very structural asset demand, and then he's going to do a wedge accounting. And what's the main finding? Well, the main finding is that the globalization has been, according to these wedges, unequal in its pace and direction. So basically, even if all the countries more or less have become more open, relatively speaking, you have that rich countries are more open to receive capital, and poor countries are more open to send capital. And that's the way the model is going to rationalize this, with this type of dynamic icebergs to capital mobilities, if you want. And the contrafactual is this part that is super surprising that Bruno was saying, is like, if I leave the wedges as they were in the 1970s, we would have been much better off. We would have more GDP, we would be more equal, and even the allocation of capital would be better than what it is now. Okay? So let me strip down the model. You saw, I hope, the whole details in Bruno's great presentation, and you see that all the part of the household is just to get you a constant saving rate part of the sigma. So that part I'm going to ignore because that's just like a way of justifying a very Keynesian world, if you want, on a constant marginal propensity to consume. So the part that I'm going to focus more is on the asset demand system, which is the thing that is really different and Bruno has been pushing in his agenda. So I'm going to try my best to use his same notation. So W is going to be the portfolio share, capital is going to be this capital stock, R is mostly the MPK, and then this tau is going to be this reveal asset. Now, one key parameter in this type of models is the elasticity of the demand, which is going to be beta here, okay? So in the demand system, if I do a just two-country example, because that's enough to get the intuition, what you get is the portfolio share is going to look with this logic way, okay? So it's going to be this type of demand. Now, what this means is that if the observed pattern is that the poor country has a higher return than the rich country, but the portfolio share are inverse, the only way to rationalize this is with the taus being very different between these two countries. So that's going to be the inversion that he's going to do. Okay, so basically, how do you rationalize this puzzle of high return and low portfolio shares is going to come from different taus. This is even more obvious if you just do the ratio of the demand of the demand that I just showed you, and then you normalize, for example, the tau of the rich country, because at the end of the day, everything is about the relative tau. That's why the relative openness is what matters. Then you can back up from the observable data. So he observes this, he observed this, and he observed this. And this is the beauty of this stuff. This is pen world tables and aggregate asset positions. And with that, it's enough for him to do this. That's what I mean, that he's making the sacrifice of having a lot of structure, but with the benefit of being able to do this with very little data. And the key identification at the end is this, is I am going to invert this equation with the bilateral part or not, but at the end is this equation that is giving him the wedges and the time-moving wages, okay? So again, this is not directly observable. It's something that is inferred from this puzzling behavior of high return, low participation in that market. So now, what about the contrafactual? Well, we already discussed the contrafactual is what happened if in relative terms, the tau p was high, which is in relative terms what it was before. You saw that divergence coming up. And at the end, the only thing that matters is relative. So in that respect, the world was more efficient before because the relative taus were less divergent. And with that, you get this puzzling result that Bruno was pointing. So that's why his other contrafactuals work, because basically what matters is the relative wedges, and assuming this convergence or this equal speed minimizes the divergence between these wedges. Everything, again, is relative. So that's the contrafactuals. Now, what is the Kool-Aid that you're drinking with these contrafactuals? You have to drink the Kool-Aid that everything here is fixed. So basically, TFP is fixed, labor is fixed, resources are fixed, factor shares are fixed. There is a risk process on the background that is just this volatility of TFP without any covariance, and it is fixed. The saving behavior is also fixed. And there is no feedback loop from globalization to any of this. So globalization hasn't increased productivity. Globalization hasn't changed the way we save, we allocate stuff. It's completely orthogonal to everything else. That's what you have to buy in order to think that these contrafactuals make sense, okay? But again, the benefit is you need very little data. So in terms of accounting, the where is going to be inferred from these capital flows that are missing. That's where the empirics come from. And then the model is going to give you this asset demand system that, conditional on those things, you can go back and get the dynamic pattern. So what do I really learn from here? What I like is the dynamic part. Like, of course, if you invert the wages in the way I show you, is pretty transparent. But the fact that this dynamic behavior has been divergent, that's something that I didn't know before and I like, okay? Now, let me give you 3 comments and then a kitchen sink slide. So first comment, assets are not serials. And this is something that I have told Bruno many times, and it might be fair or unfair, but basically whenever we use this IO system of demand, what we are saying is that for some reason, you still want to have in your portfolio an asset that is completely dominated, okay? So basically in goods, if Pablo likes Cheerios and I like Captain Crunch, this comes back to taste, you know, and it's fine. There is nothing else. But when you do it for assets, we're saying that 2 assets that have the same risk profile, the same everything, but still you want to have one in your portfolio. So I am from a school of CAPM and no arbitrage. These things, you need to give up those kind of stuff. You can microfund them. There are many ways of doing it. But then you have this paper in the background. So this is an international finance session, so we need to have a trilemma. In this case, it's the trilemma of the asset demand of a paper that Daniel Newhan has with some co-authors, where basically it tells you that if you want to use this demand system, you gotta give one of these out. The one that really hurts me is to give up non-arbitrage. Like, I think that if we talk about assets, we need to have no money in the table. So at the end of the day, let's go back to the observables. Let's think that we have the difference in returns and the difference in portfolio, and we say, okay, there are 2 ways of thinking about this. The left-hand side for me is, yes, who cares? The IO part is what Bruno is doing, okay? The part that I like, that is of course more complicated, it will be maybe harder to do with all this, is like a simple mean variance CAPM kind of portfolio allocation. So if you do that algebra, you're going to end up with an equation like the one here in the bottom that is going to tell you that the same facts are going to be now understood in terms of risk and covariance. Why doesn't capital go to emerging market? Because they're risky. And it's not that they are risky just because their TFP is volatile. They have the wrong covariances, you know. When the world goes to hell, they go to hell faster. At the end of the day, that's why you don't want your money in that bucket. All of that, all of those covariance structure, all of those risks, it's not that they are not in Bruno's analysis. They are, but they are absorbed by the tau. So if you take the interpretation that the tau are these iceberg costs to capital flows, you need to understand that a bunch of that might be bad risk allocation that is subsumed to that. There is nothing wrong in Bruno's approach. It's a wedge approach. All of that is there. But when we put economics into the wedges, we need to understand what we're saying those wedges are. And of course, there are good papers. Ina, for once, is not in the room. So Ina has a paper with her co-authors where they take this seriously and they do a portfolio analysis that is like the CAPM in steroids, if you want. And basically what they do to rationalize this is to say, look, the thing is that there is an aggregate uninsurable risk, and emerging markets covariate with that aggregate uninsurable risk much more than others. And that's why you don't want to have your money there. It's not that you cannot send it, it's that you don't want to send it, okay? And all of that is in this analysis absorbed by the tau. Now, let me rush a little bit to be on time. So the second comment that I have is to think about the following. So given what I just told you, that this tau subsumes a bunch of stuff, including risk, what would be interesting is to go beyond the validation. So what Bruno shows you is a table where he correlates things one by one. I don't want the correlation. I want to understand what explains the variations in tau. I want to have the tau with a richer regression, trying to understand how much of this is characteristics of the assets of that country portfolio. How much of this tau is basically the barriers or the political issues, and how much is the remaining in the epsilon? Because that's going to tell you really if the financial globalization asymmetry is something that cannot be explained by these observables that we have or not. So instead of just showing me the correlations, Bruno, what I would like is a full decomposition and understanding the R squared. What is really explaining your wedges more, okay? Now, the other comment that I have is something that Bruno mentioned. So basically, in order to have the data back in time, he uses this assumption that basically whenever China gets more close, it gets more close to everybody. It's not a bilateral thing. And we know these days that things are not like that. There is a lot of bilateral action. I hate you, you hate me, but everybody else are my friends, you know, and then we get all of this stuff going on. So that would imply that he needs bilateral relationships. But he has a counterfactual where he gets this bilateral part towards the end. Now, the validation that he does, again, is a cross-sectional thing, saying that this guy here correlates with this guy here quite a bit. But in order for us to believe he's counterfactual, what he needs is a little bit more heroic. What I would like him to do is to have this guy here with the bilateral part, and then see how much he can explain of that with only fixed effects that are unilateral. Because then the part that he's going to be missing is this part that is fully bilateral. So that's the part that I would like to understand a little bit more. My third comment, so that Vincenzo give me more time, is related to Vincenzo's research. You see, at the end of the day, in this type of in this type of models, financial assets are one-to-one to capital. But we know that there is many different financial assets, and the type of liberalization that you see is asset dependent. So bonds are flowing one way, government bonds are flowing another way, FDIs are flowing one way. So there is different asset classes going on. Shebnem also has research on that. So now what they do is they exclude them one by one. It would be great, instead of excluding them, running the exercise one by one and understanding for which ones you get the more asymmetric result. So taking stock is a great paper. I had some suggestions. We need to understand what we're saying when globalization is bad, because risk and covariances are into these wedges. And then the kitchen sink proposal.
Thank you so much. We'll get the question answer and then after the question to discussion. No, let's get the question, then when you answer the question, who wants to make some comments. Okay, so who would like to make questions? One there. So let's start in one there, and okay. So let's start with the first, right? Please, you can come closer or speak around.
Thank you.
I have a question about the long run counterfactual scenario that you used. If I think about a trade story, different countries have different resource endowments. And that means that even in the long run, when all these wedges are closed, we still expect different countries to have different amount of trade openness. So I think that's also one reason for why different countries may have different financial openness in the long run, and there might be other reasons for that. So I wonder if I'm curious about your thoughts on how this structure can reveal, what would be the permanent differences in financial openness, and what would be the temporary wedges or deviations from that in this exercise.
Okay. There is microphone there.
I was wondering how important is the assumption about the exogenous savings rate? Because my reading of Corinthians and Jan was that it plays kind of an important role in shaping the allocation puzzle. And in a way, I guess some normalization in your wedges translates into, I don't know if there's like a clear identification between your exogenous savings rate and what's going on with your normalization. So it's those are my questions.
No. What you would have, okay. Let's see. Pick.
Yeah. Okay. Yeah, I just have a question to kind of follow up on Philippe's critique. I think, instead of using the no arbitrage approach, you use this asset demand function approach. I mean, it seems like that if you had a pure kind of no arbitrage approach, then these poor countries would never actually take the asset positions that you choose, that you identify in a situation of open markets, just because of basically, people will not take investments that lead them to be worse off. So just, basically the first and second welfare theorems. So I'm wondering, is there a key kind of maybe critique or Lucas critique approach to your model? Because it's hard to see these countries actually investing in this way or taking these positions.
Okay, I see. How?
So one thing I'm thinking about is, your prediction, you get a return prediction with respect to the developing countries, but they're getting a big inflow of capital. So in the back of my mind is this, reality that the US stock market in particular had this enormous boom. So if we think about excess returns and stock market return, is that going to line up with sort of the return, differences that you're getting?
So maybe we can, you can answer the first couple questions and then there is one more time.
Okay, so let me start from actually, can I ask if possible to Yang to, I mean, he asked a question about long run versus short run variation in these wedges. I didn't get it completely. Maybe I couldn't hear it quite well. But I mean, for sure, yeah, there's more that we can do to decompose long run variation in these wedges versus short term fluctuations. Actually, I like more the long run interpretation of these wedges. And the reason is that in some sense of these wedges, what they are is like catch-all variables. They capture all unmodeled variation, all stuff that is not in our model. Some stuff that could happen, and this also relates to the last question about realized asset return. It could be like short-term variation in asset prices that are not in our model. Investment is real, so investment is stuff, and so that could be something that affects the short-term variation in wedges. And so, in some sense, is it short-term or long-term? I will say that our wedges better reflect long-term variation in actual openness. They might be contaminated more in the short term. Then there's a question from Ricardo about the exogenous saving rate. Obviously, that's it's something that gives us a lot of leverage for in terms of tractability. Is it a problem? Well, it's something that actually we can, in some sense, relax. It's true that in our models, the saving rate is exogenous, but there's nothing that prevents us, for example, to make it, in some sense, make it hardwiredly dependent on something else. Say, for example, population, or for example, the rate of return on the portfolio. So we made it exogenous, in some sense that sort of purely isolates the misallocation effects from these frictions, but there's more. If you think that it reacts to something else, there's nothing that prevents us from introducing a dependence to something else. And so, in some sense, our framework is flexible enough to accommodate this more complex counterfactual, though we haven't done it yet. There's a question about no arbitrage, and so the idea is, again, we are using this asset demand system as opposed to a no arbitrage approach, and this also, let me also connect to the discussion by Felipe. There's this idea that in some sense in this asset demand system, they include dominated assets. That's not technically true. You see that the portfolio share equation has this elasticity that connects portfolio shares to asset returns. Well, the fact that that elasticity is there and is not infinite is actually telling you that these assets are imperfect substitute. So it's not really that the model allows you to have dominated assets. It's that in really there's no asset that is truly dominated. All assets are imperfect substitute. That doesn't strike me as, especially since we're looking at different countries, as a crazy assumption. The main difference between this asset demand approach and sort of more like a CAPM type, right? It sort of avoids this bang type of solution more easily. It's smoother. But aside of that, you can incorporate a lot of the same dynamics. And also connecting to Felipe's discussion, one thing that we can do, for example, to make our model more like a CAPM type of model, we can replace our measure of risk, for example. That's something that we have done. If you think that actually what matters is the covariance, we say with world TFE, so basically hedging motives, we can actually replace the measure of risk that goes into the model with that, and we show that basically it doesn't really affect our model. So there's stuff that we can do to address that concern. And then the last question is actually a question that I love about the distinction between physical rates of return and asset rate of return. That's a very I think there's already some work on that shows that these MPKs are actually not well correlated at all with realized rate of return on assets. In order to actually make sense of both at the same time, you need a model that actually endogenizes the Tobin Q of each country. And so that obviously we don't have right now in the literature, but there's some interesting stuff that I'm working on that actually goes into that direction. Hopefully I will be able to show it to this audience at some point.
Very good. And we still have 5 minutes. There's some other questions? The others?
You know that the IMF has this database which really records at the narrative level all the capital measures and prescription. It exists.
Yes.
So
there's actually IMF has multiple ones, right?
I'd ask you, funds and funds, you have that some of the wages slack and others don't. Can you tie that to like interesting tie to something? Which countries are we talking about that had allowed for more inward capital flows after 1995, whenever that happened?
Yes, I don't have anything to show, but it's something that absolutely we can do. We can sort of show country by country how well these wedges correlate with the IFM measure. There's actually a list. Absolutely. It's a natural next step, and it's actually in line with what Felipe was suggesting, actually, to sort of do more to correlate these wedges to stuff that we can observe. There's also, I think, Martin has this new database that comes from textual analysis of IFM documents, that he has this new measure of capital. That's also something that we could use, for example. So absolutely, there's more that we can do to sort of open these black box of wedges, that is sort of common to all wedge accounting exercises. Any other?
Maybe I have just a comment. It's not a question, it's more a comment about the arbitrage approach versus the infrastructure approach. And one issue with the arbitrage is that very tiny change in the Dow generate a reallocation, enormous
Yes.
reallocation of money. So in some sense, this approach at the end becomes the most necessary.
Yes, that's actually one of reason why we moved in this direction is that this CAPM type of arbitrage approach implies implausibly large elasticities. It also has has a very difficult time actually matching the cross section of rates of return on capital across kinds. So if you look, for example, at the QJ paper with Enrico and Roman, we actually looked at this. We had both various measures of risk as well as these wedges, but with the difference that we actually were measuring them in the data. And with risk alone, there's no way you can capture all of the variation. You actually do need these wedges in order to produce a reasonable cross-section of MPKs across countries. So those are two reasons why we actually, this approach, while it imposes more structure, more assumption, it actually does match the data better, and it gives you more plausible elasticities.
Okay, so you already answered to the discussion, but some of the comments, if you have some other response you want to cover, otherwise.
Yeah, I mean, there was a comment by Felipe about the interpretation of the wedges. If I can just reply to that, he said, "Oh, these wedges are not just openness policy; they capture." Absolutely, that's exactly the spirit of our exercise. We don't, and let me clarify one more. We don't mean these wedges are truly just policy. We actually mean that everything that can affect the ability of a country to attract or send investment out, and that can be not anything with capital account policy. It could be, for example, the local legal system. Okay, or for example, if there's local, instability, like for example, if you have gang wars or whatever, anything that discourages investment will capture by this venture, and that's it's a feature and it's not a bug. So just to clarify, thank you.
Okay, thank you very much. We convene at 10.
And
Very good. So, all right, why don't you start?
Perfect. Thank you so much. This is joint work with Moritz, who's also here, on a model of U.S. monetary policy in the global financial cycle. So this work has been motivated by a large and growing empirical literature, to which many people here have contributed, documenting that U.S. monetary policy has large effects on asset prices, particularly risky asset prices in the rest of the world. And the resulting global financial cycle, as it has come to be called, with U.S. monetary policy at its center, has been enormously influential in both academic and policy discussions. Despite that, our view is that important questions regarding its origins and future remain, such as what makes U.S. monetary policy special in this way. What are the implications for macro aggregates that we cannot measure at such high frequencies as asset prices? And what changes in primitives might cause these spillovers of U.S. policy to change in the future? So these are the questions that we take up in this paper. And we propose answers through the lens of a model of U.S. monetary transmission in a standard open economy new Keynesian framework with global arbitrageurs that sit at the center of international capital flows and price risky assets globally. The key idea in the paper that I hope you take away is that when arbitrageurs are short the dollar appreciation that accompanies tighter U.S. monetary policy erodes their net worth, and that raises their price of bearing risk in financial markets. We're going to argue that this mechanism is quantitatively relevant in three different ways. First, starting most data on its own, I'm going to show you that the cross-section of exchange rate and global yield curve responses to identified U.S. monetary surprises line up with measures of their unconditional average excess returns. And that's a telltale sign of a change in the price of risk upon a U.S. tightening. Second, I'm going to argue that arbitrageurs, whoever they are, if they are solving a mean variance problem, that their portfolios must indeed be short the dollar if their portfolio is mean variance efficient. And third, now leaning on the view that the model disciplined to match evidence on the asset price responses to US monetary surprises implies that spillovers through a change in global risk pricing swamp spillovers through trade linkages in governing the heterogeneous effects of US monetary shocks on the rest of the world, and that these spillovers through changes in risk pricing matter a great deal for real macro outcomes. Finally, speculating a bit on the future, we argue that in a potential future with higher dollar interest rates, either resulting from fiscal pressures in the US or an erosion of the global demand for dollar assets, whatever its cause, if dollar rates go up, endogenously arbitrageurs will fund themselves less in dollars, and as its role as a funding currency dampens, the transmission of US monetary policy globally will also be dampened. Let me get right into the model. The model is an N-country New Keynesian model that should be familiar to many of you. Households supply labor, they consume local as well as imported goods with a CES aggregator. We're going to allow for sticky prices. In all the results I'll show you today, we assume for simplicity local currency pricing, and countries follow standard policy rules. The key innovation relative to our workhorse open economy New Keynesian models is in the structure of asset markets. So let me focus there. Asset markets will be incomplete. Let me tell you what assets are traded and who can trade them. In each currency, there's going to be two sets of assets we will focus on in this paper: a short-term bond and a geometrically decaying console bond. That's going to allow us to speak to the term structure of interest rates globally. I'm going to denote the decay parameter for that console bond with this delta. Second, households will be freely trading their local currency short bond. They will be on their Euler equation, this sort of three-equation New Keynesian model for each country will hold, but households will take inelastic positions in foreign currency bonds as well as their local long-term bond. We can relax the assumption of inelastic positions to have households trade them subject to adjustment costs. What matters, though, is that households are not freely on their Euler equation for these other assets, so their stochastic discount factor does not price exchange rates, it does not price the yield curve. Instead, that's going to be the role of arbitrageurs. So who are these arbitrageurs? There's a set of agents that trade in all assets frictionlessly to maximize this mean variance objective. They care about maximizing their expected profits, they penalize the variance of those profits, and they have effective risk aversion given by gamma divided by wealth, okay? Now, the portfolio choice that comes out of this is basically isomorphic to constant relative risk aversion preferences. Relative to constant absolute risk aversion preferences, the key thing is that we have wealth showing up in the denominator here. Okay? The only difference with constant relative risk aversion preferences is that away from log, you would have intertemporal hedging motives in portfolio choice. We want to abstract from that. That's why we have mean variance. And the wealth of arbitrageurs is going to accumulate endogenously over time. There's going to be individual arbitrageurs. They're going to exit at rate xi. The newborns are going to be born at rate xi. But because there's aggregation, I'm going to focus in the talk on the representative arbitrageur. Okay. All right. So let me now situate the paper in a bit of the literature. The paper and the model in particular builds most naturally on a recent literature on exchange rate determination in segmented markets. That first line of papers I have there. The distinction is that in these papers, including a prior paper of mine with Moritz, we sort of two country models where there's one risky asset, which is the exchange rate. Instead here, there's multiple countries and multiple risky assets, not just a bunch of exchange rates, but also long-term bonds and exchange rates. Okay, and these are going to be jointly determined in equilibrium. So in that spirit, the paper also relates to a recent literature on preferred habitat models in the open economy. Now, that's a second line of papers I have there. The distinction is that in preferred habitat models, those are typically in partial equilibrium. And here, the flows that are absorbed by arbitrageurs are going to be resulting in part from the endogenous capital flows that occur in any general equilibrium macro models like the ones you saw earlier today. Conversely, the equilibrium effects on risk premia will feed back to affect macro allocations because they affect both intertemporal and intratemporal decisions. And lastly, relative to all those papers in the first two lines, a key difference here is that the wealth of arbitrageurs is going to be a state variable relevant for equilibrium risk pricing. And that's going to be really at the core of our story. And that builds on the literature on intermediary asset pricing, these first couple of papers I have down here, as well as a set of papers I've written with Moritz, both in other contexts and thinking about equity risk premia or bond term premia in the closed economy. And here we're exploring its implications in the open economy. Okay, so rather than walk you through all the equilibrium conditions, I just want to focus on the part of the model that is the most novel, which is asset market equilibrium. So let's define a few objects. This first line here is the excess returns you get from borrowing in the dollar, which I'm going to order the US as country one. So you borrow at this interest rate I1, you convert at an exchange rate into currency J, you hold J's short-term, and then you convert back at the future exchange rate into dollars. I'm going to refer to this as the return to the currency carry trade. The second line is the same thing, except you're now buying the geometrically decaying console bond in currency J. And so you get the unit payoff on the console, and then delta units of that bond are left over, and you have some price risk on that bond. Okay? I'm going to call that the combination of sort of a currency carry trade and a bond carry trade, because you're riding the yield curve. And lastly, these lowercase, these are the positions of the arbitrager in short-term bonds and long-term bonds in currency J. Okay, so we're going to study this economy around a steady state in which when shocks get small, arbitrager's risk aversion is big, such that the product of gamma times sigma squared is a finite number. Okay, and this is a trick that has been used by others in the literature. It's going to allow us to go far analytically. So let me show you some of the key equations, both in steady state and to first order and around steady state in this economy. So in steady state, the portfolio choice conditions of the arbitrageurs, when they're deciding between holding dollar bonds or currency J's bonds in terms of short-term bonds, say that the equilibrium excess returns on average that arbitrageurs must earn to hold country J's bonds must compensate them for the risk of doing so. How much risk compensation do they need? Well, it depends on their price of bearing risk, gamma divided by RIV, and it depends on the quantity of risk that they're exposed to. What's the quantity of risk? Well, it's the covariance of the payoffs of that bond with their return on wealth. But what's their RIV? It's all the stuff they have in their portfolio. So you think about here, the covariance of the bonds in currency J with all these other short-term bonds K, as well as the covariance of currency J's bonds with long-term bonds in all currencies K, okay, multiplied by your positions. So this is what steady state excess returns look like. What about around steady state in response to shocks? How do these excess returns vary? Well, as you can sort of guess from that first expression, equilibrium excess returns are going to be time varying, either because arbitrageurs' wealth is moving around, and thus it changes their effective price of risk, or capital flows are moving. There are changes in the positions that arbitrageurs have to absorb, and that's going to change risk pricing according to the covariance of the asset in question with the asset that arbitrageurs have to absorb more of. So just to fix sort of ideas, I'm going to refer throughout the talk to this, this first channel, a change in their wealth, as a change in the price of risk. And the second channel, this is, I'm going to refer to it as the portfolio balance channel. This is the basic idea of Tobin, of Khoury, that changes in the balance sheet of marginal agents have price impact because assets are imperfect substitutes. And the notion of imperfect substitutability here is captured by these covariances. Okay? All right, so just to sort of step back a bit, you're going to have analogous expressions for consoles, both in steady state and to first order. And the way to think about this is then we have an equilibrium macro model in which currency and bond term premia are jointly determined with allocations. Okay, in particular, the macro to asset pricing block operates because changes in on the macro side both change asset prices and thus change revalue the wealth of arbitrageurs, and there's capital flows that have to be absorbed that have price impact, that change risk premia. Conversely, asset pricing feeds back to macro because changes in risk premia affect interest rates and they affect exchange rates, which govern both intertemporal and intratemporal decisions of households. And so one can do a lot of things with this framework, but what I want to focus on now is the conditional responses to a monetary policy shock, which is the focus of this paper. So recall that EJ is the nominal exchange rate, units of J's currency per dollar. And I want to focus your attention on the key idea in the paper that I started with, which is the fact that a US monetary shock changes the global price of risk. How does this work? The easiest way to see it is to look at the response of the full cross-section of bilateral exchange rates versus the dollar when the Fed tightens. Again, we have a closed form for that in the paper. I'm not going to show you the massive formula, but I want to focus on the key idea, which is illustrated in this excerpt from the formula. Okay, so the first round of this is when the Fed tightens, the dollar tends to appreciate versus foreign currencies. This is straightforward UIP stuff, okay? And that's going to be in this ... I'm not showing you that. What I care about is now, how does this feed back to affect risk pricing? And the first point is that when the dollar appreciates, arbitrageurs lose wealth if on net they have a positive position in foreign currency bonds, because those foreign currency bonds are worth fewer dollars when the dollar appreciates. So they take a balance sheet hit. When they take a balance sheet hit, that means that their effective price of bearing risk goes up. And that means that risky currencies in particular, currencies that pay on average positive excess returns, they require particularly high excess returns going forward to make arbitrageurs willing to still hold those assets. So in the cross-section of currencies, you should see the riskiest currencies experience the biggest price impact. In particular, if you need to deliver high excess returns going forward to hold currency J, it better be that the dollar really appreciates today versus currency J. That is, currency J really depreciates. Sort of like Dornbush, the currency J must depreciate a lot today to be able to deliver that high expected appreciation going forward. Okay. Now, what are the moments that govern how strong this potential mechanism can be? The first is the leverage of arbitrageurs, what you see in blue. How much do they hold non-dollar assets relative to their wealth? Because that governs by what percentage does their wealth fall when the dollar appreciates by 1 percentage point. And the second statistic that matters is the persistence of their wealth. If their wealth is persistently low upon a dollar appreciation, then risk premium are persistently high, and asset prices today better move a lot to deliver those high excess returns going forward. Okay, and you have, again, similar mechanisms for the price impact on the yield curve globally. So with that, let me show you empirical evidence that suggests this is actually what's going on. We're going to, in the asset pricing side, get daily data on the G10, as well as emerging market yield curves and exchange rates over the past 30 years. As you saw from those formulas, key statistics governing the conditional response of any particular shock, in this case monetary shocks, are the first and second moments of asset returns. We're going to estimate the first moments by taking realized excess returns in currencies and bond markets and just cleaning up some noise by projecting them on standard measures of interest rate differentials. Okay, you can use just realized excess returns, nothing changes. And we're going to construct covariances of asset returns using daily changes in exchange rates and 10-year bond prices. Again, you can use a factor model to simplify that covariance matrix. The results are robust to that. So here's the first key empirical result of the paper. What I'm showing you here is the global response of exchange rates and global yield curves to identified US monetary surprises from Bauer and Swanson. We're looking at 2-day changes in these global asset prices in response to these intraday Fed surprises. I'm scaling them by the response of the 2-year yield in the US. So this is a very big shock. We don't actually see shocks like this in practice. Okay. On the left, you have the response of bilateral exchange rates. On the right, you have the response of 10-year bond yields. And we're plotting them against average excess returns in currency markets and average excess returns in bond markets. When I subtract this XJ delta and XJ, what I'm left with is sort of the local currency bond carry return, a measure of sort of how risky long-term bonds in currency J are. And the message here is among the G10 currencies, risky currencies and risky long-term bonds see the biggest price impact. That is, they depreciate the most and long yields go up the most when the Fed tightens. We view this as quite model-free, compelling evidence that a change in US monetary policy changes global risk pricing. You see the same pattern among emerging markets. You can see the paper for that, and I'll show you some pictures of that later. And this is consistent with a change in the global price of risk. Now, to make that point sharper, it's useful to contrast this with the conditional responses to balance sheet policy in the US, another policy instrument of interest. To do that, we're going to use Swanson's measure of QT surprises, again, intraday, and then we're looking at 2-day responses of asset prices around that. Now, I'm showing you the responses for G10 exchange rates and 10-year yields again in response to these QT shocks, but I've changed the x-axis. In these figures, the x-axis over here is the covariance of returns on currencies, returns on the US bond carry trade. Okay, that's a measure of how kind of close substitutes currencies are to holding long-term treasuries. And over here, this is the covariance of long-term bonds in country J, US treasuries. Okay, and the message here is that in response to QT surprises, the portfolio balance channel instead much better describes the international spillovers of US monetary policy. So one way to read this is that currencies whose payoff covaries highly with long-term US bonds, when you make arbitrageurs absorb more treasuries because you're doing QT, arbs require a lot of, they require high excess returns to hold currencies that are close substitutes. And that means that currencies like the yen depreciate a lot today so that we can be expected to appreciate going forward and deliver those high returns. Now, let me make 2 points here. The first is just related to the discussion we had of Bruno's paper. We were talking about mean variance versus logit demand systems. In a sort of classical mean variance setup like we have here, these models imply asset substitution elasticities that sort of tie our hand. We don't have a free parameter. Those substitution elasticities are conditional covariances. And the point here is that these covariances do a remarkably good job in our view of explaining the spillovers of changes in balance sheet policy, at least at an aggregate level. The second point, though, is that the response of exchange rates, I think, is quite telling as you compare these two policy instruments. Conventional US interest rate surprises are sort of like exactly what you probably would have guessed. They are risk off when you tighten policy. And so risky currencies like the Aussie dollar and the New Zealand dollar, they depreciate a lot. Safe currencies like the Japanese yen, Swiss franc, they don't depreciate as much. By contrast, it's kind of the exact opposite when the Fed does QT. What's the reason? Well, basically, globally, when interest rates fall, they don't fall by as much in low interest rate countries like Japan and Switzerland. So when rates fall and treasuries pay well, the yen tends to appreciate, the Swiss franc tends to appreciate because their rates haven't fallen by as much. But as a result, the Swiss franc and the Japanese yen are close substitutes to holding long-term US bonds, and surprisingly, they have the biggest price impact when the Fed does QT. Or I should say surprisingly relative to our priors perhaps, but not surprisingly relative to the theory. Okay, so the first point here is that conventional US interest rate policy changes the global price of risk. But I still haven't shown you that this is operating through a wealth revaluation on arbitrageurs' balance sheets. To make that point, I need to convince you that ARBs are actually short the dollar. Are they short the dollar? Well, one way to answer that question would be to go get portfolio data. And there are many people in this room who have access to much better data than we do. I would argue that the portfolio data is super useful and needs to be done in concert with what I'm about to show you, but it's not a panacea. What are some of the challenges of the portfolio data? Well, first, there's a joint hypothesis problem. Whose portfolio should you be looking at? Who is marginal in these asset markets? There's also the problem that no matter how good the portfolio data is, and we've confronted this in referee reports for prior papers that are now published, people can always say, well, we don't know what the derivatives positions of these ARBs are, so how do you know what their positions are? Okay. So we're going to offer an alternative approach that we think has wider applicability and may be of interest, which is to lean on the mean variance structure of the model. Remember, if you write in vector form the mean variance efficient portfolio chosen by the ARBs, it solves this equation. Excess returns compensate you for risk aversion times the covariance matrix times your positions. If you pre-multiply by the covariance matrix, you get that your portfolio shares relative to wealth is 1 divided by risk aversion times the inverse covariance matrix times the vector of excess returns. This is the standard Markowitz portfolio formula. But what it allows you to do is say, if I measure the data, the first asset returns and what are the second moments, up to risk aversion, that ties my hands to what the portfolio of these guys must be. Another way to think about this is like typically in asset pricing, you say, I want to try to figure out where there's mispricing relative to the observed asset returns. Here, we're flipping that on its head. We're saying, I observe asset returns. What's the portfolio of the marginal guy that must rationalize those asset returns. So you can do this in many different contexts. What I want to show you now is if you do this with international asset prices over the past 30 years, the mean variance efficient portfolio has consistently been short the dollar. So what you see here is with unit risk aversion, you take the observed exchange rates, observed returns on bond yields. What is the efficient portfolio? You would take your dollar, you would borrow 3.1 more dollars, you'd borrow 70 cents each in the other common funding currencies, you'd borrow 40 cents each in the other G10 currencies, and you'd invest $1 each in each of the emerging markets in our sample. Okay, you hold a levered portfolio funded in the dollar long EMs. Now, you might say you stack the deck in favor of the dollar because these ARBs kind of view the dollar as a safe asset. They sort of live in the US, the dollar is their base currency. It turns out that if you, with unit risk aversion and you have log normal returns, the base currency is irrelevant for portfolio choice. This is related to the fact that in modern models, the real exchange rate hedging motive disappears with log preferences. Of course, the data is not log normal, but if you read this exercise, considering each of the other G10 currencies as a possible base, on average, you are again short the dollar, long emerging market currencies. Mean variance portfolios can be finicky. We sort of talked about that in the last talk as well. But this fact that you are largely short the dollar long EMs is remarkably robust. It holds when you replace government bond yields with bank rates. If you drop 10-year bonds from our sample and just focus on short bonds, or if you just look at the last 10 years of the sample. What's the intuition for this? For those that have seen this paper before, we have some new content we added recently that tries to provide a sharper intuition on why you are short the dollar. And the basic result is that the reason why you are short the dollar is not just that US interest rates are low, because of course they've been lower in places like Japan and Switzerland. The reason why you are short the dollar is because the dollar is actually highly replicable with other currencies at a lower interest rate, and the residual risk to funding a portfolio long other countries short the dollar is low. And that's because many countries, our economic interpretation is that many countries pursue, as we all know, a soft peg to the dollar. And so if you fund a carry portfolio in dollars, you can earn the spread without getting killed when the short leg moves against you. If you do that with the yen, you could get hosed. Okay, so far we've argued number one, a change in US monetary policy changes the price of risk, and two, qualitatively this could be explained by the short position of a mean variance investor in the dollar. What I now want to do is just quantitatively discipline the model to match these asset price responses and then use it to study things that you can't just read off from the asset prices alone. So we're going to discipline households' discount factors as well as their positions in the various assets, taking the other side of arbitrageurs, to match the first moments of the data that I've shown you on average. The covariance matrix depends on the full set of shocks affecting the global economy. Figuring out what are the structural shocks that have rationalized the second moments of observed asset prices, that's its own paper, and we're going to work on that. For today, we're going to take that covariance matrix from the data. So the implicit assumption is that there exists a set of shocks that you could feed into this model that would rationalize the observed second moments. The last thing is the full set of trade linkages across countries. We're going to discipline the preference for goods imported from each of the trading partners to match the full bilateral trade matrix we see. We're left with three key parameters: the risk aversion of arbitrageurs that governs their overall leverage, the entry and exit rate that governs the persistence of their wealth, and the persistence of the US monetary shock itself. We discipline those three parameters to match 28 moments of the full cross-section of exchange rate and yield curve responses that I showed you for the G10 when the Fed tightens interest rates. This is how the model does. We view this as quite good, given that we have three parameters we're choosing for 28 moments. If I add emerging markets to this, we would argue the model still does pretty good. This is total validation. The one area where the model misses is the model wants emerging market currencies to depreciate a lot because they're very risky. They don't depreciate as much in the data as the model wants. But one natural explanation for this is that in practice, emerging markets intervene in FX markets to prevent their currencies from depreciating. Remember, we didn't bake that into the model. Now, you might say it's kind of crazy. Who thinks the emerging markets are intervening in the day right after a Fed announcement? But remember, asset prices are forward-looking. If the market knows that the central bank in Brazil is going to intervene at some point, that'll affect the responsive exchange rates today. Okay, so with this calibrated model, let me now use it for a few things in my last few minutes. So the first thing is we can use the model to clarify what makes US monetary policy special. Let me start with the data. This is on the left panel, the response of exchange rates. versus average excess returns in response to a Fed surprise. You see that positive relationship among the G10, another positive relationship among emerging markets. Of course, there's a level shift, maybe because of this FX intervention business. On the right panel is the same thing, but now in response to ECB surprises. And we're plotting on the y-axis exchange rates versus the euro. These ECB surprises are taken from this widely cited paper up here. And the message first is that in the data, the cross-sectional relationship between the asset price response and the riskiness of the asset in question is just not there when the ECB tightens policy. And this is precisely what the model also generates, even though we didn't use euro surprises at all to do anything in calibration. Why is US monetary policy special, even though Europe is about as big as the US in the calibration? It's because the dollar is the dominant funding currency for arbitrageurs in the model. Second, you can ask the question, sort of, how is US monetary policy working in this environment? And to clarify that, remember, there's two reasons why there could be heterogeneous effects of US policy. There's the risk transmission. There's also heterogeneous trade linkages with the US. You can quantify their relative importance by shutting down the risk channel. So that means take excess returns, make them zero, make arbitrageurs risk neutral. This is what you see here is the implied response of international asset prices in a model with heterogeneity and trade linkages alone. And what you see basically is that this cannot explain the cross-section of asset prices you see in response to a US tightening. And we think this is important because, of course, in the classic Mundell-Fleming model or its modern New Keynesian descendants, these trade linkages are primarily how monetary policy transmits across borders. And what this result is suggesting is that at least disciplined by the asset price responses, which should be forward-looking and tell you about what's going to happen in the medium term, the vast majority of the cross-section that we see is driven by heterogeneous exposures to risk instead. Now, we can then ask, how does this affect macro aggregates that we can't observe in these tight windows? And so that's what we're showing you here through the lens of the model. The first four panels are the response of asset prices we've been talking about, the response of interest rates, 2-year yields, 10-year yields, exchange rates. And you see that when we compare emerging markets to the G10, emerging markets indeed on average, because they have a higher sensitivity to a change in risk conditions, they see a bigger increase in rates and they see a bigger depreciation. So there's a conditional violation of UIP in the cross-section. But what you see in the bottom right panels, bottom two panels, are the response of macro aggregates. Emerging markets face a stagflationary shock. They see high inflation, low consumption. That's because from their perspective, our star has basically gone up. Their external risk premium has gone up. That's why I say they see a bigger contraction. And we show in the paper that FX intervention can be one useful tool to manage that because it directly addresses the change in risk premium at its source. I'm out of time. I'll have to go quickly on the last point. Just briefly, we ask in the paper what could change in the future. And one interesting case is if US interest rates go up. Let me just advertise. We put out a paper in this week's NBER Digest or NBER, whatever, circulation of working papers that studies how much there might be a decline in demand for dollar bonds to rationalize what happened around April 2nd last year. So one reason US interest rates could go up is because of a global decline in demand for dollar bonds. Let me not go into that here. Let me just say through the lens of this paper, if US rates go up, ARBs will be less funded in dollars, and that's going to imply a smaller spillovers to asset prices, and thus a weaker transmission to emerging markets who are particularly susceptible to a change in risk pricing. So with that, I'll conclude. We extended a canonical open economy model to accommodate global ARBs pricing risk. The key idea is that when those ARBs are short the dollar, a US tightening erodes their wealth and thus raises the price of risk. We argue that this drives the global asset price responses to these shocks, and it matters for the real economy, and it might change going forward. So thanks a lot.
Thank you very much for inviting me to discuss this very interesting paper. All right, so what is the main idea and the motivation of the paper? It's basically that asset prices appear to be quite sensitive to monetary policy news, and in particular, US monetary policy news. So there are different explanations about that. A lot of people in the room have worked on this question. What this paper does is a link between US monetary policy and asset prices that goes through the risk-bearing capacity of financial intermediaries. So basically, they argue that US monetary policy shocks affect the risk-bearing capacity of financial institutions. Those financial institutions are enormously currencies mismatched in their balance sheets. The risk aversion changes and the risk gets repriced, affecting asset prices everywhere and creating a global financial cycle. Okay, so the model has a lot of components, but really the important component to understand how everything works is to focus on the representative arbitrageur. So think about the unit mass of identical arbitrageurs that basically intermediate international capital flows in the same spirit as Gabet and Maggiore, okay? So everything is standard here. There are mean variance like in most of those models. The only change is that their effective risk aversion is not gamma, is not constant, but it's gamma over wealth. So what is the effect here? The effect is that when something bad happens and I lose money, my effective risk aversion goes up, right? Okay. Now, the second important parameter there is parameter xi. So xi basically tells you what is the share of those arbitrageurs that die every period, okay? So 1 over xi survive and they carry their wealth. Xi die, they rebate their wealth to the households and the households recapitalize the arbitrageur. So xi basically regulates how persistent the arbitrageur wealth is, okay? Now, a bit on notation, I think Ron mentioned that this big gamma is basically the small gamma to make the math correct and to keep risk premia non-trivial when you do the approximation. Okay. Okay, so what are the portfolios of the arbitrageur? So as Rohan said, when you divide the risk aversion with wealth, you basically become a myopic CRRA investor, right? So we get the standard kind of Mertonian portfolios. And what the authors do here is they do something a bit unusual, right? Which is the following. They say, look, we don't know what kind of shocks generate those asset returns. We're just going to take them as given. So basically, the covariance matrix just calibrates straight from the data. They treat it as a parameter, okay? And then they match the average excess return, the risk premium, by setting the time discount rates and the household portfolio position. So for all intents and purposes, asset moments are kind of taken as given there. And they say, look, if we take those asset moments as given, how do a portfolio of a mean variance investor looks like? And the answer is it looks incredibly levered and short the dollar, right? So if you add up all the portfolio weights of the risky assets, you get like 4 and 5. That means that you're levered up 3 and 4 to 4 times, right? So you're short the dollar, right? You borrow $3-4 per dollar of your wealth, and you invest it to those foreign currencies, especially in emerging markets, right? All right, so how does US monetary policy shocks work here to reprice assets? Sorry, I forgot to mention this. So the equilibrium risk premium satisfies the standard condition, right? And again, there are two mechanisms here. The standard mechanism is the portfolio rebalancing mechanism. So think about all the models of intermediation that you can think of, like Guritzas, Ray Vallanos, Greenwood, Hansenstein, Sundaram. Something happens, right? A shock happens, might be a monetary shock, might be some other shock. Households need to rebalance their portfolios. The arbitrageurs need to take the opposite position, right, to accommodate that. Now, of course, they still need to optimize. So how do markets clear where prices adjust, right? So you have this portfolio rebalancing channel that affects risk premia. Well, here we have an extra channel that comes from the time variation in risk aversion, right? So here, as I said, when something bad happens to your wealth, your risk aversion goes up, so the price of risk goes up, and you see that in risk premia. Okay, this is a bit tricky today. Okay. All right, so what happens when a US monetary policy shock hits you? Okay, think about, for example, a tightening shock, right? So the Fed tightens. Okay, what happens to the exchange rate? So the exchange rate, there's a UIP effect, okay, but there's an extra term there. And the extra term is the risk repricing term. Now, the interesting thing about the risk repricing term is that it's proportional to your risk premium. So if you're a risky asset, and again, we don't know what makes a risky asset risky here. All we know is that it has a positive risk premium. That's how I identify what asset is risky. But when the price of risk goes up, well, the risky asset needs to have a higher premium, right? It becomes more risky in a sense, right? So it needs to depreciate even more, right? So this risk repricing term for those risky assets, it's actually an amplification term. It gives you additional depreciation apart from what you get from UIP. For a hedging asset, for an asset with a negative risk premium, of course, when the price of risk goes up, your risk premium goes down, right? So now this creates an offsetting appreciation mechanism. Now that creates a cross section, right? Because instead of having like a flat UIP, right, for everyone responds to the exchange rate, you have that, those risky currencies are going to depreciate more than UIP, and those hedging currencies are going to depreciate less, or even appreciate, depending on how strong this is. Now, the same is true for bonds, right? So risky bonds risky bonds are affected more, less risky bonds are affected less, right? Now, what determines the strength of this risk repricing mechanism? There are two things. The first is leverage. Why? Because the more levered you are, the more money you lose, the more your risk aversion changes, and the more right now on impact, your risk premium increases. But remember, exchange rates and bond prices through a present value condition accumulate future changes also in risk premium, right? So it doesn't just matter what happens today in your risk premium, it matters how persistent it is. So two things matter, both leverage and persistence, which is regulated by Xi, because that gives you the persistence of those wealth shocks, right? All right, now empirically, everything kind of works qualitatively, right? So when you look at 2-year windows in terms of FX and yield changes, you get these upward sloping curves, right? Again, you see, for example, for currencies that are risky depreciate more, currencies that are safe, they depreciate less, right? So you get those slope for exchange rate, you get a slope for 10-year yields, and they actually look at the slope for 2-year yields. And they also look at emerging markets, but they're going to calibrate using the G10, the developed countries. All right, so now let's talk about magnitudes, okay? Because remember, we calibrate, the most important parameters here is gamma, risk aversion, and psi, which is basically the persistence of the shock. And remember, gamma gives you leverage, psi gives you the persistence. So both of them matter for those risk repricing effects, right? Now they estimate the value using GMM. Again, they try to match those values there. What do they get? They get a gamma of 0.18, and they get a psi that's 2.5%, 2.6% weekly. So every week, 2.6% of those guys die. Okay. Now, gamma 0.18 means that those arbitrageurs have enormous risk-bearing capacity, right? They're very risk tolerant, so they have extremely levered portfolios, right? So they're not levered 4 times, right? They're levered like 20 times because they're much more risk tolerant than gamma equals 1. The rate at which they die, which is pretty fast, implies that their median lifetime is about half a year. So every half a year, on average, those guys die, right? So what do we have here? You have a huge leverage effect because those guys are super levered. So upon impact, what happens to the risk premia? They go up a lot, but those premia die out very quickly, right? So the effect on the exchange rate comes because you have those really big effects early on, and they really die out, okay? Now, you might say, hold on, why don't we make those guys live longer? So then you can have lower leverage, right? You can have a smaller effect upon impact, but it accumulates more because it lasts longer. And the answer is because you try to match three different slopes. You try to match the FX slope and the 2-year slope and the 10-year slope. And the thing is that those things are different, because think about this. The exchange rate's an infinite maturity kind of asset, right? The 2-year bond only lasts for 2 years, the 10-year bond 10 years. So when you change psi, the impact, it's not the same in the term that regulates persistence, right? So the psi is the same, but the coefficient is not the same. So for example, when I try to make those guys live for 5 years on average, the term that multiplies exchange rates goes up by 10, but the term that multiplies bonds goes up by 6. Why? Because the bonds stop accumulating after 10 years, right? All right, so basically, what makes the situation here a bit peculiar in the sense that you have enormously levered, very short-lived guys, and you have those huge effects on their wealth, right? So think about what happens when a contractionary shock hits you, a tightening shock hits you. Those guys basically lose everything, right? This is like a minus 700% log change in wealth, okay? The risk aversion goes up a lot, but it quickly reverts to steady state. So their conditional risk premia increase a lot upon impact, but reverse to steady state quickly. What does that give you? It gives you enormous short-term predictability in the premium, right? Because the premium need to adjust a lot for the exchange rate to increase because they die out very quickly. Okay. And again, you can't just change psi, right? Because it doesn't, you lose the slopes. So they have an extension in which they consider a second type of arbitrageur, which is a risk-neutral arbitrageur with a value at risk constraint. And those guys are identical, those two types in steady state, but they differ upon impact of a monetary shock. So what happens? The value at risk guys delever, they sell their assets to the mean variance one, which lever up. So here, instead of having the first mechanism, right, the risk repricing mechanism work, you go back to the standard kind of portfolio rebalancing effect. So why? So you can fit everything with a higher gamma. You don't need as much leverage, right? But why don't you need leverage? Because the guys that are, the mean variance one, on top of that, they lever up, right? So they take all this enormous quantity of assets coming in, right? So what happens? Does that solve the problem? Does that solve the problem that you need a huge spike and then it dies out very quickly? Actually, it makes it worse. It makes it worse. So look at the risk premia, right? One is for the exchange rate and the other is for the bond. So the light blue is the new model. Okay, so you see that even if the leverage is lower for those guys, the response upon impact to the risk premia it's higher and it dies out more quickly, right? So why is it higher? Because remember, those guys are less levered now, but they get dumped a bunch of assets that they need to absorb and require even higher risk premia. Okay, now this is because I think the way that the effective risk aversion is specified is overly restrictive. You tie it too much to wealth, so you just need to lever up. I mean, there are other ways to do it in which those monetary shocks affect risk aversion, but the effect is more persistent, right? So you can actually get a smaller effect in risk premium in the short run, but it kind of accumulates and gives you the effect on the levels. For example, Flügger and Rinaldi have a model. They don't have intermediaries there. They just have a household, a representative household that has habit preferences, and the habit is persistent, so risk aversion changes are persistent. Okay, so what is special about your monetary policy? The only way that makes the US special is because those arbitrageurs are really short the dollar. Why are they short the dollar? Because they're mean variance guys, and asset returns, which we take as given, tell them to do that, okay? So the authors write in the paper, the dollar is the dominant funding currency in the efficient portfolio because historically its return has been low relative to its risk. Now, to me, that restates a little bit the US dollar funding advantage. The authors might say it's not the case, but I kind of think it's the case. Now, one mechanism to give you that, I see Hanno and Zhenyang here, it's a convenience yield for dollar assets, right? And in fact, they do have a paper that they produce an alternative mechanism that US monetary policy generates a global financial cycle that hinges on the convenience yield. But their convenience yield needs to be time varying, because upon impact, you have a UIP effect, but you also have, upon a contractionary shock, you have the convenience yields going up, which creates an additional kick, right? All right, so let me skip that. One small thing is that if we try to match those slopes that tell you what happens in the FX returns during the day, the peculiar thing is that a lot of the returns happen pre-announcement. Okay, now if that's information leakage, I think the model is fine. The model doesn't care if it's like before 215 or after 215. But if the pre-announcement premia are because of risk compensation, that's a bit tougher for the model to address. So it's worth thinking about this. I mean, there's an extensive literature that looks at like pre-announcement effects, right? Not just for stocks, but also for bonds and effects, which is relevant here in terms of disciplining the quantities. Okay, so I did a fun little thing. I said, okay, let's pretend I am an actual financial institution and I have mean variance preferences and I want to actually make money. Now, typically you won't do individual currencies. You would do something like carry value and momentum. Okay, so I just got the portfolios. And the good news for the author, I've criticized a lot, but I have good news for the author, is that if you do those standard strategies, you do get a large dollar, short dollar position. So it rings true that someone that actually has beyond variant preference and wants to make money will be a lot short the dollar and actually get leverage that's for gamma equals 1. That's very consistent with what we have. So they have 4, 5. I have 2, 3, right? Okay. Now for gamma equals 1, I get my portfolio to be very volatile, but I don't get wiped out. I just get wiped out like in the financial crisis, but I still survive. Now, the good news is that I'm still, positively beta on the dollar, which tells you that they are exposed to dollar risk, as they say. And also they're negatively exposed to fixed innovations, which again ties it to the global financial cycle literature. So qualitatively, this works, but if you lever up, you get wiped out all the time, right? So I don't know who those guys are, but in reality, if you try to lever up so much, you just get killed all the time. So probably we need something that fixes that issue, right? And again, it probably has something to do with the alternative specification of the time variation risk aversion. Thank you very much.
Thank you. So let's collect some questions. Mr. Man, the back. So let's start with the back.
Thank you. So those of us in the empirical counterpart of this literature have spent a lot of time thinking about who the marginal arbitrageur is. And so you give quite a few facts about who you think this is. They're trading both bonds and FX. They're highly levered. They're short the dollar. They're long EMs. And so who do you actually think this describes in the economy?
Excellent paper. So I would like to go back to discussant's comment on this, how to hit the persistence and the risk premia and then quick coming down. So you have the value at risk guys making it worse. But if you have these long-lived arbitrageurs where, Gartner-Karadi types where the future network is important, then that balance sheet effect is going to be also important. And then you can, create persistence, especially, on the emerging market side of the portfolio.
Let's see, some other questions? So for the time being.
Sure.
I want to respond.
Okay. First of all, thanks so much.
Go ahead. The next question.
Sure. Thanks, Andreas, for a very thorough discussion. Okay, so first, who are the arbitrageurs? Yeah, we are intentionally sort of agnostic on that in the paper. We'll sort of leave that for the rest of you to figure out. The one thing I'll say is that certainly our reading of the literature, and there's people here that have worked on this, is that many emerging markets we know are kind of dollar funded, and they're exposed to local currency revenues in their firms. The point we're trying to make is that if you sort of the global financial system overall is sort of channeling savings in dollars into these EM assets. And so this is a bit of a sidestepping the question, but our view is that sort of that system overall is largely dollar funded, holding EM exposure to EM revenues. Who in that system is really bearing the exchange rate risk? That's something that is outside our comparative advantage. We sort of your own work, Hillary and others, I think we've learned that dealers themselves appear to be very much hedged. So maybe they're not the ones who are really bearing this risk. That's sort of why we think this mean variance perspective is interesting. We're not trying to tackle the question of who's actually bearing the incidence of this. On Shebnem's question, which gives me an opportunity to respond a little bit to Andreas as well, on persistence. So I think it's important to distinguish between there are two components to the evolution of arbitrageurs' wealth. One is the exogenous persistence or lack thereof that is coming from this exit entry rate. The second is the endogenous persistence that is coming from realized excess returns. And the point we make in the paper is that no matter really what you do with that psi parameter, the model wants when there is high excess returns, arbitrageurs earn those high risk premia and they quickly get recapitalized. That's why in the baseline model, you need such high leverage to match the price impact you see in the data. And for those that were there, the asset pricing meeting 3 months ago, sort of we got the similar comment, this leverage is kind of nuts. But trust us, we don't want such high leverage, but that's what this class of models implies. And let me point out the karate style models have the exact same issue. I think Saki Biggio in his job market paper made a similar point that this endogenous, you earn the high excess returns, but that means that this thing is pretty short-lived. Now, in that context, let me offer a different spin of the extension that Andreas offered. He described to you that we put in the appendix, because we think it's quite interesting. So what we're doing in this appendix, which I didn't mention in my talk, is basically we have two sets of arbitrageurs. One is mean variance. The second is solving a risk-neutral problem subject to a value at risk constraint. And it's been well known that the mean variance portfolio can be microfounded as just risk neutrality subject to a value at risk constraint. What I think has not been well appreciated is that the dynamic response of portfolios in those two environments is quite different. A mean variance investor would like to take high leverage when risk premia go up. But that's sort of the problem here, is that that's quickly dampening the response of risk premia. A value at risk investor, when they take wealth losses, they need to shed assets. They cannot lever up that much. And so he sort of didn't emphasize this, I think, in the way that I would have liked, which is we view that as a solution. It's a sort of a feature, not a bug. Because in a world where 98% of the risk at capital is held by value at risk agents, which seems reasonable, then they're dumping assets in bad times. And so somebody else has to absorb them, and that generates big price impact. And so in the version of the extension with these two ARBs, if you have that kind of wealth held in the hands of value at risk arbitrageurs, you only need aggregate leverage of like 2 to match the asset pricing data, which seems much more plausible. And last thing I'll just say is that, we had this discussion in the last talk as well as this one about sort of like portfolio flows, portfolio balance, mean variance versus logit. I think another way of framing the issue is that I think we made a lot of progress in thinking about inelastic markets and so on, but we don't have very good theories of what generates flows, what generates trading flows. This two arbitrageur model with changes in risk aversion generates flows that move prices where those flows line up with average excess returns. And that's precisely sort of the risk-off behavior we see when the Fed tightens interest rates. So I think we're comfortable standing behind that model. I think it's a pretty good description of the world.
So this is kind of a small comment on matching the emerging markets, kind of the level shift down. I wondered if you could make progress by matching that better, by allowing them to have different monetary policy rules potentially than the rich countries. So like, thinking about some of Shebnem's work, if they are actually kind of responding to these flows and to the changes in wealth more aggressively, then you might be able to match the dampened effect in a more empirical way than just, because it's harder to match what they're doing on the FX intervention side than to observe what they're doing with their monetary policy rules.
Thank you. I have a question about the connection with Gebek's majority. So this is sort of a type of model that fits into that class of models. And I thought, if I remember this correctly, then in Gebek's majority, countries that accumulate large persistent current account deficits, their currencies will tend to be risky because these intermediaries are kind of forced to take long positions in those currencies. And so here's the question. The US is one of these countries that is accumulating large persistent current account deficits, but you get to reverse that whole thing. And I'm not quite sure how that works because I thought the takeaway from Gebek's majority was kind of the opposite. So that's one thing I'm wrestling with, but maybe I'm missing something. I haven't thought about this in a while.
Thank you. Those are both great questions. Let me start with the policy rules question. So I totally agree. The model we started with was intentionally symmetric. In the later parts of the paper, we think about alternative policy rules like targeting your exchange rate or FX intervention. I think one interesting thing though is, there's people here like I think of Shebnem and Geeta and Pierre's paper that sort of thinks about policy responses to US Fed surprises, how they may differ between emerging markets and advanced economies. Those are the kinds of things you could feed into this paper and in this model and see how well they can account for the data in a structural sense. Another way you could use this paper is saying, what do I have to believe about how much central banks are intervening to match the asset price responses on impact? We often don't get good data on what the intervention is. I think the structural model offers a way out. So there's lots of things to do there. We were kind of intentionally symmetric in the presentation I gave you. I appreciate Hannah's question. It also gives me a chance to connect to another point that Andreas made about convenience yields. So what Hannah was pointing out, which is exactly right, is that in this class of models, arbitrageurs require a premium to hold assets that they are long, but assets that they are long must be assets that somebody else is short. And so you tend to get in this class of models that countries that have large NFA deficits, they're borrowers, they tend to have high interest rates. Now, this is true for like emerging markets, but the US is clearly one salient counterexample. And the US dollar played an important role in this talk, so you might wonder, how is this all hanging together with NFAs in the world? And here I think the key distinction is that the positions of the arbitrageurs are not equivalent to the positions of the countries overall. There's a distinction between the portfolio of the marginal agent and the cross-border portfolios. And that's a distinction that is made particularly clear in this paper, although I didn't emphasize it, because we could, for instance, have, and we do this, our baseline calibration, the arbitrageurs live in the US, and their counterparts are agents in the US, households in the US. In our baseline calibration, just to make the point super clean, there are 0 NFAs. And yet there's a full cross-section of excess returns and a full rich portfolio because ARBs are taking the other side of the US households. That's an extreme point, but it makes the point that we need to, in this class of models, decouple the NFAs from the positions of these guys. Now, there's then this question, how do you discipline the positions? We offered a way using asset prices alone. Now, this gets to the point about convenience yields. So we explain why are the households taking the other side of the ARBs. But I would view actually our story as quite complementary with Hanno and Zhengyang's and Arvind's, which is the ARBs are price takers. They just see low interest rates and low funding risk. They want to borrow in dollars. Well, somebody else must really want to save in dollars to drive interest rates low in that way. And we don't model that, but the very natural explanation is that globally there's a demand for dollar assets that is bidding down its interest rate. What we think is kind of interesting is that when we don't look at CRP deviations, we don't measure any the sort of convenience yields in the way that you do. If you take a mean variance perspective, you still get the same result. And so I view these as quite complementary with each other.
Yeah, you didn't want to mention the appendix when we mentioned it before. I don't know.
Very good, very good answering questions, presentation, everything.
One second, sorry.